So hello everyone, hi, how are you? I hope everyone is doing good. Yeah, this side Chartered Accountant Ashwini Bhanushali, your coach, your tutor, your mentor for ATX. Yeah students, let me just confirm once we are live or not. Just give me a minute. So yes students, so yeah, everything is perfect and our praise and our study is also very perfect. So yeah students, without having any further delay, let's just discuss what was a quick revisionary plan. Okay, so on day one, if you remember, or maybe if you went watched the video prior, so students, on the day one we have completed and analyzed about what is the paper pattern, how are we going to understand, and what is the way, like before examination I need to do it to get the superb marks. Okay, so this is a session basically for the December 2023 and March 2024 attempt paper. So I know the things gets predated and updated. Yeah, so every time we have a new finance act which we have to go ahead with. So this time students, we have covered up the important topics which students tend to leave. Yeah students, so with that I'll just give you an overview of what are the things that we have did it and what are the things that are going to upcome with us. Okay, so the first session we have understood about the income tax administration. So if you haven't watched the income tax over your administration, and if students want to know more about income tax computation, that is something I have already did it in September 2023 video. So students, we have that videos with us. So I thought of, when we are having a revisionally series, let me have something new, let me have something which the student may leave, but this is the chapters, these are the points which can gain you from 45 to 55 marks. Legitly I'm telling you students, these is a topic which students tend to leave just because maybe they don't get time, maybe they feel like, oh, the chapters are a bit boring, ma'am, the chapters are more of theoretical part, ma'am, the chapters are somewhat, we don't like it more. That is first point, which is income tax administration. Then we have covered up the best topic and the best point, which was tax planning. Yeah, personal tax planning. So what was the planning, what was the avoidance which we should not do it, and what the way we need to plan it about the income tax. So today we are at a position where we can start it with the new chapter which is known as inherent tax, which I know multiple of the students will leave. So over here students, I don't want you to leave this chapter. It is one of the most easiest chapter which we have, because this is not something about like in just I'll just write things. You just need to tell me yes or no. Yeah. See students, when I'm having, let's say, income tax, okay, when I'm having income tax, it talks about income tax. Okay, it talks about income what an individual has earned. Please listen to me. It's an income which an individual owns, and on that income the person is liable to pay taxes. Yes. Then we have a corporation tax. Okay, we have a corporation tax. Yeah, just a minute. Yeah, I'll just write it down. Okay, we have corporation tax. If an individual company earns some profit, it's a liability, it's a duty to pay the taxes to the government, right? If it's something on the purchase and sale, we have value added tax, that is VAT. And in case, what is an inherent tax? Means, ma'am, in the inherent tax, the person who receives something has to pay tax. So there is something different. Now this inherent tax is also known as wealth tax. Okay, it's also known as wealth tax. So who is going to pay? So before I go ahead with the concept of inherent tax, students, let me welcome you all. Yeah, this side Chartered Accountant Ashwini Bhanushali, your tutor, okay, for ATX. We are going to go ahead today. Our agenda is to cover the two most important topic, which can be worth 8 to 10 marks in your upcoming paper. So what are those? So we'll be learning today inherent taxes, and we'll be learning the concepts of value added taxes. Okay, so without having any further delay, let's just start with the inherent tax. So when I just speak up with the word inherent tax, so most of the people know the word, means you'll say, "Okay, ma'am, when some or the other person dies, yeah, and if the property has been given to some other person, that is inherent. Inherent means something which is continuously coming from like the priors. But I'll give a slight change. It is not always the tax which you have to pay only after the death of the transfer. Yeah, something like I am alive, but still if I'm transferring something, yeah, some assets or something, can I give a tax on that? So with this concept, we are going to understand the inherent tax. So when I just speak up, the inherent tax, we have two parties. We have two parties. First one is known as the donor, the one who gives the gift, okay? Gives the gift. In front of that, there is a donee, the one who receives the gift, isn't it? Yeah. So over here, as per the law, normally as per the income taxes, the person who receives income, like for example, if I'm doing employment, I'm getting income, I have to pay taxes. If I'm doing my business, I'm getting profits, I have to pay taxes. So over here, do you think the donee has to pay tax? No. The law is changed over here. So over here, the donee is not liable to pay tax. The donor is going to pay taxes. That means over here the tax name is IHT, inherent taxes. Over here the word comes like decrease in the wealth of the donor may not be always equal to the increase in the wealth of the donee. Yes, students. That means if the donor gives the gifts, right, obviously there is a decrease in the wealth which the donor had, but it is not equivalent to what the donee gets. Yeah, because like if I have already explained in the class, if I'm having two pair of shoes, like one pair of shoes, like left hand and right, the value that they have and the value which individual right leg have, the left pair had of the shoes, is altogether different. The same way we just need to have a word that says me that when it is inherent taxes, it is not always the same. So basically inherent tax is computed where it's computed on the decrease in the wealth of donor. Okay, so inherent tax is computed in the decrease in the wealth of donor. Getting it? Yes, wealth of donor. Hey students, I'm going to write a lot of things, okay? Because when you take up the notes which is there basically in your ACCA study resources, there are huge and ample of notes. So I'll try to make a precise notes. When you can also have a notes together with me, we can have a writing together, and that will be very easy. Okay, so today let's say if I want to analyze what is the wealth, that means what is the gift, on what amount will I pay the taxes. For the donor, what is the amount on which I need to pay taxes? So we have one like a formula, if I can say a formula that we have, which is known as what was a donor's wealth before giving gift, and now what is the wealth which is left with the donor after giving gift. Means what is the property that he had prior and now what he is having. The difference is nothing other than the gift which he has given. Getting it? So wealth of the donor before gift. Yeah, so we'll write it over here. Wealth of the donor before gift, and over here we'll be getting some wealth, like it wealth of the donor after giving gift, okay, after gift. So now he'll be definitely having some or the other reduced wealth, isn't it? So that is nothing other than known as decrease in the wealth of an asset. So decrease in the wealth of donor, and this is what we are supposed to find it out. Okay, this is the amount that he has given the gift. Agreed? Yes. Are you clear? Yes. So this is just a starting point which we need to understand. So what are we going to calculate on? We are going to calculate the inherent taxes basically on two types of like gifts and something like that. Okay. So yeah, with this overview now students, we can just start the chapter which is inherent taxes. So yes students, without any further delay, we are going to start with the inherent taxes. So students, we have a wonderful concepts that we are going to go ahead with, and obviously we are not going to take up so much of time because it's a revisionary part. So maybe I may not take up so to the depth, but I'll take up all the important topics. Okay. So inherent taxes is the taxes which is also known as transfer of wealth, that is based on gift. Okay. It is a capital tax levied on the person's total wealth accumulated, which is known as estate. Estate means it's a combination of all the assets the person do have. Okay. Primarily on the occasion of person's death. That is what we know. So inherent tax has implications on lifetime gifts as well as on death. So if you can just read one word, there are two words which is impacted over here. If you can read some words, there are two words impacted. So basically when I calculate inherent taxes, I have to calculate on two things. I told you, okay, it's not just a person dies, okay, afterwards, like he has created a will and he has given some asset to somebody, only after his death I have to pay taxes. No. It's something which is also known as lifetime gift. So inherent taxes are calculated on two parts. It's basically calculated on the lifetime gifts and basically on the death estate. Okay, students, so these two words are very important. Then if I go again over here, when I take up a concept which is known as lifetime gifts, even my lifetime gifts is bifurcated into two parts. Means if a person like my grandfather or somebody who wants to gift me, for example, okay, he can give me, it's not like that only after he dead, like if only after he died, if he gifts me, it will be taxable. No. Even in the time when he is alive, if he is gifting me something, even that is also taxed. So when it is taxed, when it needs to be taxed. So yeah, the government is not so cruel, but there are two types. So basically there are two types of lifetime gifts on which there is a tax. So what are those two types, guys? It's known as PET. Okay, it's known as PET, or you'll be wondering, ma'am, what it is, or CLTT. So you'll be saying, ma'am, what it is, CLTT. Students, I'm trying to make it easy. CLTT. So it's PET, guys. What's PET? Okay, if you just read the word PET, it's something which is known as potential over there. Okay, the word is over here. If you can see over here, the gifts are potentially exempt transfer. Are you getting it? What's that? Potentially, your potential is basically that the gift which has been given is most probably exempt, but it is some other gift which is known as chargeable lifetime transfers. Okay, are you getting it? So yeah, because there are two types of gifts: potentially exempt transfer and chargeable lifetime transfer. Potential exempt transfer, and over here there is something which is known as chargeable lifetime transfer. So ma'am, what is the meaning of both this stuff? Is this both gifts different? Okay, so when I say, students, the meaning of lifetime transfer and death estate, which is the first point. So what is lifetime gift? Lifetime gift over here means, if suppose, for example, if I am having my son or daughter, so what I did, I was alive and I was giving gifts to my son or maybe daughter. I have given my son the car, let's say I have given my daughter my jewelry, etc. So that is what it is known as lifetime gifts. Means I am still alive and even I have given some gifts. And normally people all know that after death, like, there is a fight between the family because they want what? Death estate. Means whatever is left over, and if I have given something after I be died, so yeah, that is known as death estate. So when I say my lifetime, means when I am alive and if I am gifting something, even that gift is transferred or bifurcated into two parts. When I am still alive and if I am gifting my loved ones, it is also bifurcated into two parts. So what are those two parts? It is known as PET, potentially exempt transfer. So when you break the word potential, maybe in the gift is having an essence of let that be exempt, and another one over here is chargeable lifetime. Okay, so if you just speak out with the two words, it's potentially exempt and the another word is chargeable lifetime transfer. So now we are going to learn it like simple way. We are going to learn it individually. Students, I know why am I preparing all the stuffs, just to make it feel easy. Okay, just to make it feel easy. Okay, for example, I'll just go ahead with the PET, potential exempt transfer. So what is the meaning of potential exempt transfer? So basically this is a gift which is given to any person on that please keep highlight the words. Once if you're good with the definitions, your 3/4 work to calculate the questions is over. Seriously, I'm telling you. But people leave this definition, they don't pay more of attention on the definition, they run behind the questions. Are Baba, first understand the definition. See, whenever in taxes, if I'm telling you, if you want to know the core concepts, just understand the meaning. Then the questions are very easily manageable. Okay. So it is PAT, potentially over here, potentially exempt transfer means it is gifted to any person. Okay, it's gift to any person. Okay, first I'll write the point. It's a gift to any person. Okay, you can have the like the handwritten notes passed first along with me also. Second, on the date on which I make the transfer. For example, over here, if I'm just taking up the dates, I'm taking up the line. Okay, let's say in 2015 and 16 here, basically Mr. X gifted a car to his son. Okay, let's say he's alive. Okay, he's still alive, he's alive. Okay, he's alive, and let's say he died in which year? Maybe 2024. Let's see, I'm expecting something like that. So if you see 2015, maybe 15, 16, 17, 18, 19, 20, 21, 22, 23, something along, like maybe. So I just mean to say he is alive, and this is not yet came, means he is still alive. The person is still alive. So do you think he's so cruel that okay Baba, he's still alive and you're paying taxes on him just because I'm gifting a car to my son? Seriously, should I pay taxes? So you'll say, okay, ma'am, no, it's my family part, ma'am, I don't want to pay taxes. So yes, students, no IHT is paid, no inherent tax is paid in which year? In the year of gift. That means, ma'am, you want to say that in 2015-16 no need to pay tax. Yeah, in 2015-16 please don't pay tax. But then, ma'am, when to pay tax? Or should I pay tax? Okay, to know that, we need to understand if the donor of the gift, the one who gifted, for example, if the donor, let's say, if the donor, Mr. X, if Mr. X died within a period of 7 years, oh my god, within a period of 7 years, when he just gifted him, if he died within a period of 7 years, then that gift becomes taxable in the year when he died. Oh my god, seriously? Yeah. If he died within 7 years from the date of gift, sure, on the date of death, like on that period of death, the tax is payable. The tax IHT is payable. So ma'am, on what amount should I pay? Like for example, he didn't die till here, so maybe more than 7 years. So the gift is potentially exempted. But what if I told you in this year 2018 only he died? Oh my god. Then you have to pay the taxes. Let's say in 2017 he died. Oh my god. Now let's say he gifted the car to his son on this date when the value of the car was, let's say, $1 lakh, or maybe let's say, forget about dollars, let's say pound only, 1 lakh pound. Okay, when he died, guys, the value of the car was turned around to be 1.5 lakhs, so 150. So should he pay the taxes on 150 or 1 lakh? So yes, for these at least my government is good. So my government told you are not supposed to pay taxes on the market value. No. Whatever value was there on the date when he has actually gifted, yeah, you can pay the tax on that. So over here, it's not supposed that you are going to pay the taxes. You're not going to pay the taxes when he actually died. It's okay. Whenever he was alive, if he was having the value of 1 lakh, please pay the taxes on 1 lakh. Did you understand? Yes. I request you guys to, like, if you didn't understood it, please pause the video, go behind, check it within 5 minutes in 1.5 speed, and yeah, you can come up again. So students, over here, PET means potentially exempt tax. Your intention are that the taxes should be exempt. Your intentions are the taxes should be exempt. Okay, for sure the taxes need to be exempt, and you want that, students. Okay, once the taxes are exempt, for sure you should gift your whatever. If I want to gift, I can gift it to my relatives or whatever I want to gift it, but I should be alive till 7 years. Means it should not be a tax planning. Like, let me gift him, the gift will be exempt and I'll die. No. Within a period of 7 years you died, then the gift is to be taxed. On the date which you made a payment, in which you gifted him, the value whatever was there, that value you have to pay the taxes for. Easy. So that is known as PET. So let me understand the meaning of PET for first. Okay. So over here we have chargeable lifetime and we have potential and we have some exempt transfers also. So I'm going ahead with the PET. So what's PET? The potentially exempt transfer is one on which no lifetime tax applies and charges is not applied if only if the donor or the transferor dies within a period of 7 years, then it is to be taxed. Agreed? Okay. So if you read it over here, IHT applies to the transfer of the value of the chargeable property held by an individual. A charge of inherent taxes arises on the death of the individual on lifetime gifts when the transferor dies within a period of 7 years. Okay. If he dies within a period of 7 years, then he has to give the taxes. Okay. So the trust over here is an arrangement under which the legal title of the company has been settled. So there is a settler and trustees. Okay, that's fine. But now you will come up, okay, ma'am, what's the meaning of this CLT? What is this chargeable lifetime? Yeah. If I say you chargeable lifetime transfer means it is a gift to whom? Okay. Now CLT is basically a gift over here, a gift to trust. Okay, it's a gift to trust. Okay, in which we need to understand it's a lifetime inherent taxes on the CLT. Means you have to pay the taxes. Means over here now, it is something like it's a gift which we are giving it to the trust. Okay, it's a chargeable lifetime. So the meaning over here it's chargeable. That means we have to pay taxes for sure. See, when you break up the words, you'll get a huge amount of understanding. Means it is something which we need to give a gift to the trust, which is again chargeable. So if it's chargeable, definitely there will be some taxes. If you see the taxes, Baba, these taxes are also in two parts. Means you have some lifetime taxes that you have to pay and you have some additional taxes to pay. See, when it was potential exempt, your intentions were to exempt it, right? But if you died within a period of 7 years, then it becomes taxable on the day you died, that like that way. But now when it is CLT, okay, now when it is CLT, it is taxed basically in two parts. That is lifetime tax. That is, you have to pay some installment in the year of gift. You have to pay the tax on the year of gift. Means whenever you give the gift, you have to pay the taxes. Like we need to know, like when should I pay, when will I pay? Okay, so it is basically understood as a first installment and compulsory. It should be paid by the trustee. Okay, who is gonna pay? Yes, students, please take care. It is gonna pay at the rate of 20%. It's gonna pay by the rate of 20%. And who is gonna pay? Paid by trustees, because you are giving gift to whom? Trustees. Okay, so that is the first point. Okay, I'll just write it. If I want now, what I can do it, I can write it in the different page. Okay, so when it is CLT, so it's something like chargeable lifetime transfer. Okay, so basically CLT is a gift given to trust. It's a gift given to trust. Cool. And it's a gift given to trust. Along with that, it's basically understood as a lifetime IHT on CLT. So it's basically I have to pay lifetime taxes to CLT, and that lifetime taxes is nothing other than, if I can say it over here, it's also understood as a first installment I have to pay, first installment. And if I just check up further, if the donor dies within a period, yeah, but what if donor dies within a period of again 7 years, oh my god, this will not be enough, they have to pay something more, means additional tax they have to pay. So what they have to do, guys, if the donor dies within a period of 7 years, additional inherent taxes will also be payable. Inherent tax I have to pay on the year of death. Means if you can relate it over here, the day when you give the gift, it's the first installment. Means over here, on the date of gift I have to pay the first installment. Over here, on the additional taxes on the date of death, only if he dies in 7 years. Means first it is compulsory that lifetime you have to pay the first installment tax, which is compulsory. But in case if he died also within a period of 7 years, then he has to pay additional taxes also. So then it becomes the two liabilities. This is compulsory. This is only and only if he dies within a period of 7 years. Otherwise, this tax will not be there. Okay, so when it is understood as such, same over here. Will the market value be changed? So no. Whatever was the price that he thought on the day one, means whenever he gifted, whatever was the value on that day, we will consider that much amount only and we'll pay taxes on the additional basis also. So yeah, that's fine. Now when you see the options, so we have two types of options. Again, we have two types of options to pay taxes, two types of inherent taxes options. So what are the options? So it's always understood first as it is paid by trustee. The taxes are always paid by trustee. It's paid by the one to whom I'm gifting, the trustee, which is always 20%, no grossing up. But if I'm paying, for example, paid by donor, the one who is gonna gift, so how much tax he's gonna pay? Students, he is gonna pay, yes, 25% tax, and yes, he'll be doing gross up. Gross up means he'll be taking it up all the taxes, means he'll be taking it up the inherent taxes total value also. That means what? He'll be considering whatever the taxes are. Along with that, if he is getting any sort of exemptions, he'll be considering that also. So over here, it's a total of what? CLT after getting exemptions, along with that, whatever taxes he paid. Yeah. So it's yes, we have to gross up, and over here, no grossing up. No gross up. So if you understood it, it's well and good. Otherwise, don't worry. We have a very wholesome concept which we are supposed to just learn it. Okay. Yeah, I'll just mark it over here, but don't worry if you're not getting it, guys. We'll be having a full-fledged theory for that also. So okay, just if you guys are initially also understanding the concepts, like even if this is the first time for you guys to understand about this, I'm very happy that you will be able to correlate things. So if you read it now over here, a chargeable lifetime transfer is one which is liable to inherent taxes when the gift is made at a lifetime rate, which is basically half the rate applying to the death. If want, plus an additional tax is also paid if he dies within a period of 7 years. Yes. So if you read now, an individual has to transfer it if he has to pay a tax within a period of like 7 years, because if he died, so he has to pay an additional tax. A trust is an arrangement under which the legal title and the control of the property is transferred from the trust, the one who is going to pay, to the trustees or the beneficiaries. So inherent tax is chargeable to individuals and the trustees. It does not apply to companies. No, it's for individual. Okay, it's for individual, and if I'm going to gift it to the trust, so it's the trustees. So the person who gives away the asset is the transferor, we know the person who died it maybe, or maybe the donor, and the one who receives it is nothing other than the donee or the transferee. So this is what we know. Now if you read it, chargeable properties for inherent taxes is what? On what property if a person transfers, then the taxes are included, and what are the property if he transfers, taxes are not there for inherent taxes. So chargeable property for inherent tax purpose is all means all the property to which a person is beneficial or entitled, unless it is excluded. Unless what? Unless these excluded properties are there. That means if these type of property are transferred, inherent tax is not there. Unlike CGT, means in the CGT the concepts are different as compared to what we have in IHT. Unlike CGT, there is no concept of a chargeable asset for IHT. Asset treated as exempt from CGT remains still liable for IHT unless they are excluded from the property. So exempt assets for CGT, like you remember when we were doing the capital gain taxes, yeah, so these type of taxes are not there. So which type of taxes? So these are some exempt tax from the capital gain, that is such as taxpayers private residence, no, not taxable, qualifying bonds and cars, no, but these becomes taxable to IHT. Okay, so what are the properties on which if it is transferred, still the inherent taxes are not applicable? First is overseas assets owned by individual who are not the UK domicile person, and the revisionary interest in the trust funds. Yes, so you have to remember it. Okay, so you have to get it. So if you remember, what is chargeable transfer? On what price will I pay the taxes? So first of all, what is the value of transfer? Okay, what is the value of the asset that you are going to transfer? If you're getting any annual exemption, because the government is not so cruel, they'll give you some exemption. you reduce it and get the value which is known as chargeable transfer. I hope you guys getting it. Yes? Okay. Now, what is the transfer of value? What's this transfer of value? At times, we have the value, as I told you, it's getting decreased. So it's a decrease in the value. So the measure of the transfer of value is the amount by which the transferor's asset is decreased. Why? I told you on the day one, like in the part one. If the donor or the transferor is gifting things, it's gifting to transferee, his value is getting decreased, isn't it? His value decreases. His value decreases for sure. Because I am gifting something to you, so my value will go, because my asset, I'm giving it to you, so my asset is any which ways going to go down. Yes? True? Chalo. Then diminution in value is the measure of the transfer of the value, which is the amount by which the transferor's assets, like the real asset, the real estate, is reduced by the way of gift. Yeah. Usually, but not always, diminution, the value which is decreased, is the value equal to the market value of the asset which is transferred. Yeah, we know that. Cool. For the lifetime, transfer market value is the value of what? So I told you for the transfer, yeah, like you remember right time, I'm going to transfer the asset to you. So what's the market value? On the date of transfer, whatever is the value, we have to take that only. Yeah, we have to take that only value. So transfer market value is the value on the date of transfer. Yeah. So for property held at the death, market value is the value immediately before the death. If I have kept the property prior to death, the value, so it will be that. However, a difference can arise between the market value of the asset transferred and the value which has been reduced when the asset depends upon the proportion. So a good example of the unquoted shares can be there. Yeah, fine. Okay, we can just have a word on that. So yeah, so over here now students, we have a question with which we'll understand better way what is known as the transfer of value. Yeah, this is there in our notes, so I would like you guys to like have an answer for that. Okay, just try to read it. There is some valuation of the asset which is quoted or unquoted shares. The value has been decreased. So yeah, let us just go ahead with the example and try to solve this question. Okay, yes, so that is known as transfer of value. Okay, so it's the transfer of value for the first. Yeah, give me a minute. We'll try to code this easily, We'll try to make the answer easily. Please read, please try to read. Mr. A holds 15,000 £1 ordinary shares in an unquoted equity investments that has been issued as a share capital of 25. So the company is having, let's say, 25,000 $1 shares, and my share is, let's say, 15,000. So can you tell me what can be my percentage? Please do now. 15,000 divided by 25k. Please do it. 15k divided it by 25k. Are you getting nearly 60%? Yes, ma'am. So we'll say, ma'am, I'm holding right now 60%. So yeah, they have also given the value per share. The value of 60% which I'm holding it right now, along with that having a majority, so I am having a controlling power, the value per share. So how many shares I'm having it? Let's say 15,000 shares I'm having it into 10. So maybe if I can see, my value turns around to be 1,50,000. Agreed? I'm just writing it. Please correlate it. Okay. Have I transferred anything? No. It's just that I am having this much assets or this much value of shares. Then value of 48% holding. Meantime, what happened? You may have sold it. Means the value would have decreased it. So for example, how much shares they would have gifted it? So the market value of 15,000 shares is 15,000 because the transfer of asset of Mr. A's entire, we have to consider the interest in the share of the company. If Mr. A is now holding only 14%, so obviously 12% is something which is sold, or maybe not sold, then it may be gifted. Yes, if it has been gifted. So what are the number of shares? So if 25,000 into, let's say, 12%, if you do, are you getting something around 3,000 shares? Yeah. So 3,000 shares now valued at 8. Oh my god. If it's valued at 8, don't you think the value is like just 24,000? Can I do like that? No, ma'am. You have to think. Now 3,000 is something you have gifted it. Okay. So now I am left with 15 minus 3. I am left with only 12,000 shares. So I have to book 12,000 shares into only 8 because now the valuation has been turned around. So 12,000 into 8 means initially I was having 150. Yeah. Now I am having only 12,000 into 8, which is known as 96,000. So ma'am, there is a value which has been decreased decreased. Are you getting it? Yes. Yeah, cool. Yes. Over here, if you can see, okay, I'm just writing it over here only. Okay, chalo na, it's okay. We can at least get the things over here. Okay, I think like it's visible. It's okay. Yeah, okay. So I got to know this much, ma'am. Because the value has been decreased. Decreased by how much? If you check it, ma'am, initially it was 150 minus 96,000. So I think, ma'am, there is a diminution of valuation of 54k. Yes. So maybe there is a diminution of 54k. Okay, this is what I'm just holding it and understanding it. Okay. Now there is still a sales of 12%. Oh my god. So from 48, it's now only 12%. Oh my god. So that shows how much you would have made the sales for. Ma'am, it's a huge amount of sales that I would have made. Yeah, isn't it visible? Yeah, ma'am. So maybe now what can be the value? If you check 12% only you are having it. So 25k into 12% means now I'm only holding how much? Only 3000 shares I'm holding it. And even that is gonna value only 6 means it's only pound 18k. Oh my god. So isn't it very low? Yeah. So we have to understand it. How am I going to write it? Okay. So for that, if you can just analyze it first, what we will write the answer with. We're going to formulate the answer. Okay. See, students, if you want, just copy the question or just maybe take a screenshot. I'm not going to go again and again to show you the answer. We'll just try to formulate the answer. Okay. For the first, I have to analyze. Okay, what was the value on the day one? Okay, what's the value on the day one? So before transfer, let's say I was having 1,50,000. Yeah, 15,000 into 15k into 10 pound. Okay, then what happened, guys? Yeah, if you remember, some number of shares I have like sold it. Yeah, before transfer it is this much only. But now there is something like diminution because now there is a transfer. So now when there is a transfer, first what happened? Now I'm wholly having how much shares initially? So 12% you made a sales for. 12% you made a sales for. Now you have how much shares? 3000 is gone. So now, ma'am, you have only 12,000 shares. Agreed? So now Mr. A has given. Now if Mr. A gives only 3000 shares to his son, okay, as a gift. Mr. A gifts 3000 shares as gift, and now I am having only 48%. So how much shares I am having it, guys? Because 12% is what I have gifted him. So before transfer I was having 150, but now after transfer, before transfer I was having 150, but after transfer, what's my wealth? After transfer I am having only, let's say, 12,000 shares into what was the value? If you remember, was it 8? Yes. So I'll just take up 8. So which comes around to 96,000. Oh my god, ma'am, my wealth has decreased. By what have your wealth decreased? So you are having a diminution of value which is nothing other than 54k. So this is how I mention it. I told you, na, something which was before, something which is after. So the difference is nothing other than the diminution. Is it clear? Yeah, superb. Now what happened? Ma'am, the market value has fallen down more bad. So my god, the market value has fallen more bad. So maybe if I can take it. Now, for more 3000 shares at the end, which you have transferred, it has gone very bad. And the value is only 6. So maybe now it is 18k. So ma'am, the value has fallen down very, very bad. So what I'll write? The market value of 3000 shares which is transferred. In this instant, because the gift of the minority interest is a loss of control. So over here, we have to just show it how much it is gone away. Okay. Are you fine with it? You are clear? Yeah. Are we good? Yes. Can we go ahead? Yes. Is it simple? Pakka? Yes. Okay. So this was the first answer which we can do it. Then now, students, you remember I told you something about CLT. Day one I have to always book the first installment. Ma'am, the first installment I have to pay the taxes. Plus, if the person died within a period of 7 years, within 7 years, then you have to pay additional taxes also, additional IHT. So first what I have to do, the lifetime IHT, when an individual makes a CLT, it's the first stage. Then if he died within a period of 7 years, yeah, then he has to go with the second stage also. Means what he's supposed to do, he's supposed to pay the additional taxes also. He's supposed to pay the additional taxes also. Yes. Or if the IHT on the death estate, yeah, the last topic, when he has died, means what you have to do when he died and he have actually gifted something. When an individual dies and remaining property held as at fail, so that is my last step. So over here, if you see, as already mentioned, we know there are 3 types of taxes. Exempt means no tax. PET means you have to pay taxes only if it dies in 7 years. Only if it dies in 7 years. But when it is chargeable tax, CLT, immediately I have to pay tax. Plus maybe additional I can pay if he dies in 7 years, within 7 years. So students, this all things you should know before you start doing the questions. So, okay, so if you just read it over here. A CLT is any lifetime transfer, CLT lifetime except the PET on exempt transfer. Means any lifetime transfer to whom? To trust is CLT. So we know we give something to trust, and if I'm giving something to trust, the trust has to pay taxes at the rate of 20. But if I pay taxes, I'll pay taxes at 25%, but I'll gross up and then I'll pay. Okay, I'll gross up and I'll pay. Okay. A PET, that is potential exempt transfer, is a lifetime transfer by one individual to another and not to trust. Okay. PET never suffers a lifetime taxes because we know it will be only tax if he dies within 7 years. But CLT has to suffer the first tax also, that is lifetime. The first installment he has to pay plus additional tax if he dies within a period of 7 years. Otherwise, no. Now, if this was understood, okay, this was understood. Are there any sort of exemptions? Like you told, na? Okay, ma'am, we are having 2 parts, like, sorry, 3 parts. First is PET, potential exempt tax. Like it needs to be exempt, but if you have transferred it within, like if you died within a period of 7 years of transfer, then you may pay up the tax. Okay, that's the first part. Second over here was, okay, if it's not about the died, but if it's about you have transferred something gift to the trustee. If you have given some gifts to trustee or to the trust, then initially pay tax. But if you want, maybe if he died within a period of 7 years, pay additional, otherwise don't pay taxes. And certain exempt taxes. For example, yeah, see for example, my husband gave me gift. Okay, if he is alive, he gave me gift, it's good, pretty cool. If he is not alive and still with the will he gave me goods or gifts, it's still exempt because something, it's yeah, like family. Yeah, what will be then text? So exemption application for lifetime transfer and death estate to spouse exemption. Yes. So a husband and wife are separate persons for IHT, yes, just as they are for income tax and CGT. We know separate computations are also required with each spouse entitled and exemptions, and use of the nil rate band is also taken care of. Additionally, if there is if you just read it, if there is any transfer, okay, just read it, any transfer of asset between the spouse or maybe the civil partners made, please keep this word are entirely exempt from IHT. So at least this is better, na? They have got the exemption. Because Baba, you're not supposed to pay the taxes. You're not supposed to pay the taxes. It's something like, yeah. Now even if the government starts collecting taxes on this also, it is not valid, isn't it? Like just imagine after the husband's death, like every property has been transferred obviously to the wife, right? Like it's domicile, like everything is transferred. And if you start collecting the taxes on that also, so like maybe the people will leave UK and come up. Yeah, seriously. So the most important implications of these exemptions are 2 parts. The first spouse to die can leave the whole of the estate to the surviving one. If the one person died, everything is left over to the second person, and the one spouse can transfer in his lifetime also without incurring the liability. Means even he is alive, he can transfer. Even after death, if it has been transferred with wills and all, it is exempt. It is exempt. Easy, super easy. Yes. So we have one word. I'll explain you that maybe right now or maybe afterwards, but you will understand there is one band, nil rated band and something. I'll explain you. So if you remember, I told you, okay, we'll be provided with the tax rates. In the tax rate also it's given. So yeah, let me just show you, okay, what are the things which you need to learn it, and if you don't learn it, it's fine. Yeah, I'm just opening it up. Give me a second. I feel like you guys are getting confident after understanding this. And like, see students, I have taken from the scratch. I'm not expecting that you must be like getting it or not, but like it's not something like you should know all the stuff, so I'm taking it from scratch only. Okay, so where it is my inherent taxes. Can you understand this topic? Yeah, nil rated band, it's 325. Means if a person gifts something, so they get an annual exemption or like some exemption of 325. But if it is a resident nil rated, I'll explain you what's a resident. It's 175. Okay, so if you see 325, if you just divide it by like not even by half, but it is something like 175. Then some rates which are flat rate, okay, which are flat rate. On the lifetime rate is 20%. Even after death, it is for sure your tax rate is 40%. Then we have a concept which is one of, oh I'm so sorry, which is one of my favorite concept, it is known as, you will understand it, which is known as taper relief. So you'll say, ma'am, what is taper relief? So don't worry, there is some relief even if you die. From behind we calculate it. Yeah, I'll explain you what's taper relief. So if a person died, I told you na, if he dies within 7 years, yeah, so like allegedly if somebody died within a period of 7 years, he was not having any tax plan, so people will come, Kare Baba, he died, Baba, we are any which ways in very pain and sorrow, can you please reduce your taxes, can you please give some exemptions? So yeah, they'll give you with these rates. So students, a very big congratulations that we don't have to learn these rates. So I hope it's a simplest thing. So we have 2 points to be known. Inherent taxes, I am having nil rated and tax rates, and inherent taper relief, I'm getting it, TAPER, taper relief. Okay, so right now I'm not concentrating on that because it is to be understood like after 2 minutes or after 10 minutes. Oh, I'm so sorry, I was having a note. Cool, chalo. Okay. So we have a taper relief also along with us. So yeah, can you just read it? Yes. Okay. So yeah, what it has given, the exemption applies. Okay, yeah, give me a minute. Yeah, this exemption applies to a full value of all the transfers made by the transferor. Okay, this is an exemption which has been applicable to whom? So yeah, this just a minute. Yeah, so this exemption applies, but which exemption are you talking about? Spouse exemption, or understood, spouse exemption. So this exemption applies to the full value, of transport made by the transferor. To whom? Made by the transferor, like I'm the transferor. If I'm giving something to my wife or to my civil partners, so it's an exempt for what? In the lifetime or even after the death, unless the donee, unless the one who is the donor, no, who is the party donee is not a UK domiciled or deemed domiciled, means he or she is not that person domiciled one, so then it is a different way. If the donor is a domiciled or deemed domiciled, but if the donee is not domiciled or deemed domiciled, then the spouse will get an exemption of 325. So what was that 325? I told you, nil rated band. So here we get a relief of 325. Then this limit applies to the gifts within 7 years prior to death and any other gifts. So students, if you just understand it, try to please correlate it. Okay, when it has been understood as a gift which is given to the wife and somebody like that person, okay, it is clearly understood, like if any transfer is there, okay, if there is any transfer of asset between husband and wife and between the civil partners are always exempt. Cool. But unless until it is been domiciled, if it is not domiciled in UK, then definitely whatever is there with the normal people, they get the reliefs, you will get the same relief. Okay, that way. Now if you read the next point, which is other exemptions. So what are other exemptions given to the, what are other exemption on which they don't pay taxes? So here, transfer to UK charities. If I'm gifting anything to charities, why? Because they want okay, you just have more good expenditure in the charity. So there is no minimum limit. Okay, there is a reduced rate of inherent taxes. So over here, just a minute, okay, Yeah, oh, it's not like going up. Okay, cool. So there is no minimum limit, but there is always a reduced rate of inherent taxes. So okay, so you have to pay something like a lesser tax, which stays at least 10% of the base amount you pay. So we have a wholesome chapter for that. Yeah, we have a wholesome chapter for that, and that is not a big issue. Then gifts for public benefit or for national purpose is also exempt. If you're promoting anything and if you're gifting it to the benefit of the company, or sorry, benefit of the public or the nation, they will encourage you. They will not charge upon that also. So because they want, okay, if I'm contributing something good, so yeah, let's make it free. Such as gifts to museum and art galleries. It's always better. So maybe in your examination you can be asked like, okay, we have gifted to so and so. What is the amount of inherent taxes you have to charge? Are Papa, we don't have to charge anything. It's an exempt gift. So exemptions are to be known. So gifts to the qualifying, this is also important. Gifts to the qualifying political parties are exempt. There is no limit for exemption. Just imagine, political parties always, they will get only the gifts. The political parties is qualifying if at the last general election they have been getting a proper value. For example, either at least 2 members should have been elected, or maybe like one member was elected out of like 1 like 50 votes. Okay, nobody will ask you like that way. Okay, a normal expenditure out of income is what? What's normal expenditure out of income? Are Baba, what I'm doing? Am I gifting? No. Let's say if I'm giving my son, like my son is having, okay, I'm having my son. Let's say I'm gifting him daily, or maybe after every weekend I'm giving him pocket money, or maybe if I'm paying up his school fees and everything. Is it a gift? It's a normal regular thing. If I'm gifting my daughter on something like gift or gold on birthday, is it something on Christmas if I'm gifting him, or gifting her? Is it something like taxed? Is it an inherent taxed? No, ma'am, it's just a gift. It's not something which is inheritant. Okay, so please don't get confused between these two words. I'm trying to make it very easy. So over here, the normal expenditure is not equivalent to the taxes that you all are going to pay on that. So a gift of cash of any value will be exempt if it can be shown that the gift is made out of my current income. Means I am earning income. Yeah, I am getting the income, and on that income I am working very hard, and I'm just trying to fulfill my like small gift. It is known as small gift. Okay, these types of gifts are known as small gifts. So what small gifts? Daily I'm working. Okay, so it's on my outcome of my income. It is like habitual, and obviously it is not going to affect my standard of living. Along with that, it is in the normal course of action. Like I'm paying up the school fees, I'm paying up the tuition fees, I'm taking up the normal routine course. So yeah, so a gift of any cash value, and that too from my current income. So the conditions must be satisfied. So what are the conditions? If you can correlate, the conditions are: first, the gift is a form of regular giving, means normal. The transferor's after tax standard of living is not reduced. Means, oh my god, if I'm giving you gift, I am like very bad. Like I was staying in 3 BHK, now I have to stay in like 1 room kitchen. It's not that way. It's a normal course of an action. Okay, so it's not going to impact my financial impacts. So if this is possible, only then it's a exempt gift. Means in practice, this exemption will be most likely applicable only where the transferor has a very large regular income, and other remaining income is also maintaining the living standards. So if you just read it, I told you it's a small gift. So small gift means what gift? Okay, I'll just make a page. Okay, if you get like in the examination now, try to like recollect this way. Small gifts means what, guys? First over here, if I'm gifting pound 250 per person as a physical year, means pound 250 per person in the physical year, in any fiscal year, means that means what, guys? More than 250 if I'm gifting to one person, that will be taxed. But if I'm doing the normal routine course action means it's basically out of my income which I'm earning it, a normal expenditure, normal routine core gifts, it's exempt. Don't have to pay taxes on that. Or maybe something is habitual, and if I'm paying them taxes, if I'm gifting something in the normal course, it will not affect my standard of living. if it's not going to affect my standard of living, then it's small gifts which is acceptable. Clear? Super easy? Yes. Just then read it, okay? Just then read it. So a small gift for the lifetime transfer should not be more than 250. Okay. The exemption applies separately to each transferee each year. So this 250 will be from 6th April 22 till 5th April 23. So basically, yeah, from 6th to 5th, okay, to 1. Okay. The exemption does not apply to PAT in excess of 250. That is, it cannot exceed, it cannot exclude over here, it cannot exclude this 250 means what? The first 250 means what? The exemption does not apply to gifts to trust. Means already we have PAT. You remember? PAT, and we have CLT on which I pay gifts to trust. So these exemption does not apply to PAT. Means already you are having some potential benefits, right? Potential exemption and all. For example, if I'm gifting something to my son, okay, in that I will not do carry, ma'am, initially 250 to any which ways was exempt. No, that type of criteria are not there. It is not my small term exemption. No, my PAT and my CLT is not that small term gifts. No, it can be cars or whatever it is. So like this type of exemption, you cannot claim there and go and, ma'am, 250 was exempt. No, please don't do like this, okay? Please don't do like this. In practice also, this exemption will be particularly useful to parents or grandparents for the small gifts for the children and not the large one. Okay, so now if you understand what is the gifts, like what is the gifts, or maybe what is small gift, or maybe what is large gift, okay, so try to please correlate. And this exemption applies to lifetime gift or a party to marriage. Marriage is like marriage, because that is something which is beyond, right? So try to understand, guys, try to understand when it is marriage, when it's marriage exemption. So what's the situation for marriage exemption? In marriage, you know, people have a lot of like desires. Okay, I will give this gift to my daughter, I'll give this gift to my son, oh, I'll give this gift to my pota poti, means my grandchild. Yeah, so they have a lot of lot of expectations, they have a lot of enthusiasm to gift their loved ones, isn't it? So can I then that gift, you gift, pay tax first, pay tax then you gift. Arey papa, nobody will do that. But that never means, arey marriage na, whole property I'll gift her. No. You cannot manipulate the thing. Either you have to take care very well. So what is the meaning of marriage exemptions? So over here now, it's first divided by 3 parts. Okay. First gift, who gives? Always tell me, who is going to give you first gift? Ma'am, my parents will give. Ma'am, my grandparents will give. Then maybe the other person who comes and attends my wedding will give, right? Agreed? Yes. My parents will give, my grandparents will give, maybe other one will give. If my parents give gift equivalent to pound 5,000, oh my god, how much? Pound 5,000, it's exempt. If my grandparents give me a gift of pound 2,500, it's exempt. If others give me a pound 1,000 in the marriage, it's exempt. Means what's that? Let's say my parents gifted me pound 7,000. So first 5,000 is exempt, first 2,500 is exempt, first 1,000 is exempt. Means now how much is taxable? Only pound 2,000 is taxable. From my grandparent, let's say if I got a gift of 3,000, only pound 500 is taxable. If I'm getting a gift of, let's say, 2,500, only 1,500 is taxable. I hope you guys understood it. Yes. Means what? Let's say my parents, my mother and father, together they gifted me some amount of, let's say, 10,000 pounds. So for initial 5,000 it is exempt, and for remaining 5,000 you have to pay tax. Otherwise what will happen? अरे फुल प्रॉपर्टी जायदाद सब कुछ मैं मेरे बच्चे की शादी के नाम कर दूंगी. That is not allowed. You cannot put everything in the name of the marriage to kids. No, not at all allowed. Understood? Not at all allowed. It's not at all valid also. Otherwise, there are huge chances of manipulation which cannot be acceptable. Agreed? Yes. So marriage exemption shows that parents, grandparents or others, okay. So first 5k to whom? 5k obviously to whom? To parents, exempt. Grandparents 2,500 exempt, others 1,000 exempt. But now if you remember over here there was 250. Small gifts of 250. What happened in the current era? my parents gifted me small gift of pound 280. Ma'am, pay only on 30. No. If it's small gift, no first exemption. Full payment. Full exceeding 250. Full. If it's exceeding 250, full amount you have to pay taxes. Means, see, it is any which way small gift, yaar. We are giving you 250 is exemption now. Why are you paying extra? Okay. Arey, it is a marriage. Marriage, so you will pay something, right? If from the marriage allowances, if you're paying something extra, the extra thing we will charge. But not the base value. Getting it? Yes or no? Yes or no? So yeah, if you can make this picture, see, whenever in the examination you go now, like, see, it's there. I'm telling you, with the time you get the things learned up. But to read the theory, like if it's a theory given, oh my god, I'll take a lot of time to read the theory, right? So what I can do, I can make some pictograms like that way. It will obviously be helpful for me to get more knowledge, and that too with the reduced time I can like learn many things. So why not to do this way? Yes. Then over here, let's understand about the exemptions. So these exemptions applies to lifetime gifts to a parties or marriages. Like from my parents it will be 5,000. From my gifts from my remote ancestors like grandparents it will be 2,500, and from others, friends and relatives, it will be 1,000 only. The gift must be considered for marriage, maybe civil partnership or whatever it is. Yeah. The marriage exemption can be, yeah, please take this care. The marriage exemptions can be deducted from larger gifts. There is exemption for the first 2,500 of the gift and 4,000 from the parent. Like, it's just one example that way. Understood? Did you got it? Yes? Pakka? Yeah. So now if you read it over here, annual exemption. So by now we have understood about the marriage exemption. Okay. Now we have to understand about one more topic, which is known as annual exemption. Means what? For example, if the person has received any gift, for example, if I have received any sort of gift, any gift, if I have received, or maybe the donor has paid any gift, so will he have to pay the tax on full? So they have given a good news for us. Okay, Baba, if you are giving any gifts now, if you are giving any gifts, always go from left to right. Means go from the first thing to last. Means what to do, ma'am? What are you saying? So you get a basic exemption of 3,000 pounds every year. For example, in the current year if I gifted, I get an exemption. Okay, Baba, 3,000 pound you don't pay. Tax you don't pay. And in the previous year I will see whether I have taken up any gifts, like whether I have like previous year means how many previous year we have to see, like whether in the past I have any which ways given taxes or I have given any gifts. If no, we can use the current year's exemption of 3. We can use the previous year's exemption of 3 also. But if I am not able to use the exemptions in 1 year, it will get elapsed. Then you will not get you can accumulate it on and on and on and on. So maybe just try to read it, okay? Just try to read it first. So the first 3,000 of the lifetime transfer can be taken at to 5th April is exempt. Means first, whatever you are gifting it, 3,000 pound of the transfer is exempt. The exemption is applied against any gifts in the chronological order. Okay. If the gift is PAT, what's PAT? Potentially exempt one. The exemption still applies. Yeah, they have exemption. Even if the PAT might never be chargeable. For example, if there is PAT, means I have given a car a gift and I know I have given it to my son, and if I died after 8 years, then this tax will never be applied, but still you get exemption if you want. But if I died in 6th year, so I will get the exemption of 3,000 for sure. If the person is making, okay, are you getting it? Yes? Just please read it. If the person is making, what if the person, oh I'm so sorry. If the person is making both PAT and CLT in the same year. Now, if I'm giving some PAT also to my son and to that trustee, if I'm giving any gift like trust, in 1 year only, they should make the CLT first to ensure that the annual exemption is effective. Why? Why? Just imagine. Is it sure that your PAT, can you claim it for sure? Arey Baba, when will you pay PAT? After 7 years. But you know, when it is CLT, I have to pay today itself, right? The first installment. So utilize it na. Why to wait for 5 years? Sorry, why to wait for 7 years? If he didn't died, then the exemption is gone. So it's better you have to pay the taxes. You have the liability today, then utilize it that way. So it's the first priority to utilize it over what? Over my CET only. So that shows. And over here, let's say in the previous year I haven't gifted, so I'll be having previous year's 3000 unused exemption and the current year's 3000 unused exemption. So let me first utilize this, and if I want previous year, if I have unused, if I'm having unused exemption, please utilize that also. That means an unused annual exemption may be carried forward for only 1 year, only 1 year. So it also must be applied to the current. So how much can I take? I can take an annual exemption of 6000 if in the previous year I haven't used it. Okay, if two different exemptions are there, for example marriage and annual, the annual exemption is always deducted last. Yeah, we know it's at the end we will deduct it. So students, please read it. Please try to read it again. I'll just explain you about exemption and we'll be doing one question. Okay, just if you want, I'll just delete everything because it is important. Huh? Because it is important. Otherwise, I will not take so much of time in these. Yeah. Okay, just give me a minute. Just try to read it, guys. I'll go slow. For the first, obviously we know when it is annual exemption, or maybe if you want, I'll just write it for you guys. Okay, so when it is, guys, an annual exemption, we need to know when it's an annual exemption, it is always applicable to first, like in the current year I can get an annual exemption of pound 3000. If in the previous year it is unutilized annual exemption pound 3000, so first I will utilize this, second I will utilize, so total I can utilize how much? Pound 6000. I can utilize it as my annual exemption. That is clear. Yes, yeah, cool. Easy. Yes. For example, if I'm having both the stuffs, like am I having PET also and I'm having CLT in the current year, if I have made a transpo, I know, okay, PET, there is potential taxes, maybe I can pay once he is died, only then I have to pay. It's not compulsory. So maybe he may die, may not, I don't know. Maybe I have to pay taxes, maybe not, I don't know. But CLT though I have to pay 2 times. Yeah, you remember? First installment compulsory. And if maybe may not over here, if he died within a period of 7 years, then additional taxes I have to pay. So it's better now to utilize the exemption year only, first year. Yes. Getting it? Cool. So this is the concept of annual exemption also. So with that overview, let us understand the first, like the second question. Okay. I'll not just waste more time. We'll just have an understanding of the question. See, wait, it's an example 2. Oh, activity 2. Just a minute. Okay, am I getting the same question? Wait. Yeah. Chalo, we'll not waste more time. We'll just try to get the question. Okay. Chalo, we will take the question easily. So there is some talking about some exemption. Yeah. First, there is a company, the person has made a lifetime gifts. So to whom he made a gift, if you see the years, it's from 1st May 2020. He has gifted first on 1st May 2020. 1st December he made a gift to trust. 25th September 2021 he gifted something to his son. 1st Feb 2022 he gifted to the trust, again a trust, and something to the marriage for the daughter. So this many gifts he has given. So first, if you see this, okay, gifts to sister. Okay, when can the exemption come? Ma'am, 2021. Ma'am, this is which year? Ma'am, 2021. So in 2021, if he has gifted 1500 to his son, to his daughter, or to his sister, don't you think we any which ways an annual exemption of 3000? So yeah, 1500 will come under exemption only. So there will be no taxes to be paid. So zero tax. In the year 2021, I have already utilized 1500. So still in 2021, I can utilize 1500 more. Yeah. So if you see in the current fiscal year only, oh, the company has given some gifts to trust of 2000. Okay. Out of which, do you think that I may be able to carry forward? Yeah, ma'am. You can say, ma'am, First of all, current year's 1500, you can utilize it over here. So ma'am, there will be 500 taxed. Arey, but Baba, prior to this year, haven't you made any gifts? Ma'am, I haven't made. So maybe current years I have utilized it. So previous year's 3000, can I utilize it? Yes, for only one period. So yes ma'am, I can utilize 500 over here. So now it will be 0. Now it will be 0. Students, please try to understand it. First utilize current year, then you go behind and utilize it. If you are able to utilize it the previous years, but if you are not able to utilize it, still it will not be more than 1 year. So more than 1 year you cannot carry forward. जो भी करना है settlement, do it in 1 year, that's all. Getting it? Yes or no? Yeah. So maybe after this question we can take up a break, but yeah, just keep things rolling up in your mind. Okay, rolling up in your mind. Then year ends. Then 21-22 year comes. 21-22 year comes. Okay, till here any doubts? Till here any doubts? Okay. Chalo, first of all, let me do the answer till here only. Let me just do the answer till here only. So for example, I'll just write it 2021, which is a year from 6th April 20 till 5th April 21. So in the previous year, have I paid any taxes or have I was having any gifts? So no ma'am. So in the previous years, I was already having an exemption of 3000 pounds. In the current year also, I'm having an exemption of 3000 pounds. So in the current year, what I did, guys, I given 2 gifts. In the current year in 2021, I gave 2 gifts. Which 2 gifts? 1500 to my sister and 2000 to the trust. Okay. So 1500 to my sister and 2000 to the trust. Date I'm not writing it, but if you want I can just write the dates also. But yeah, cool. So in the current year, what I'll do it first, I will utilize this current years. So maybe I will use the annual exemption of 1500, so I'm not able to pay any sort of taxes. For sure it's not there. So no lifetime taxes. When I gift to trust, okay, I gift 2000. So remaining 1500 I will utilize it of current year. And maybe out of this previous year also I can utilize it 500. So again I don't have to pay any sort of taxes for sure. Clear, 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 clear. Till here no doubts, isn't it? So my this year is also over. So 2021 is cool. 2021 is done. Done and dusted. So I can just cut up over here. Because once it is gone, it's gone. Huh? Now you cannot utilize that year. Now which year? From 6th April 21 till let's say 5th April 22 year. So this comes in that year, this comes in that year. Okay, two things comes in that year. On 25th September, 240 is given to his son. Small gifts till 250 exempt. Yes. Small gifts 250 exempt over here. Ma'am, small gifts till pound 250, ma'am, exempt. No need to pay taxes. Am I supposed to write anything? No ma'am, it's very clear. It's legitimately very clear. No taxes. But ma'am, I have gifted 4500. Oh my god, how much? 4500 to the trust. Now, ma'am, I am having the annual exemption in this year of 3000. But can I take the previous? Ma'am, previous year I have already utilized it. So, minus 3000 pound. So, pound 1500 is to be taxed. We have to pay an inherent tax on that year. If you remember, if it's a trust, we have to pay. But I'll go up again and I'll explain you. There is something other band also which we can go ahead, and that is known as, maybe my students knows this, that we have a concept which is known as nil rated band. So you get an exemption of 325 lakhs. So 3,25,000. So you can utilize there. Okay. But right now, this as per exemption, I know. With the exemptions, I can settle only 3K. And the remaining may be taxed, or maybe I can take up the annual exemption in that way. Okay. Getting it? Pakka baat? Yeah. If you get it this way, na, matlab students, just imagine how good you are getting the concepts. Okay. Up next, if you just read the question, what they have given. Ma'am, this year is also over. Now, okay, I have just completed till year. Now what it is, guys? Which year? Ma'am, now 6th April 22 till 5th April 23. Now this comes in this year. What happened? 1200 given to trust and 10,000 given to daughter. Okay, initially 1200 to trust. So in that current year also I'll be getting an exemption. So yeah ma'am, 3000 exemption I'm getting. So 3000 exemption I'm getting it. So maybe 1200 I can adjust it. So no tax. But what about daughters? if I am giving my daughter's wedding, you remember only 5,000 you can give, only 5,000. So remember, remaining 5,000 I should pay taxes, should I? Or am I having any exemption left? Yes ma'am, out of 3,000 you were having exemption, you utilize it only 1,200. So your remaining 1,800, remaining 1,800 is still pending. So I can utilize more 1,800, and on the remaining stuff, on 3,200 only, I'll pay taxes for sure. So I'm not writing it clearly, but I hope you guys are understanding it. Yes? Or do you want me to write it clearly? Getting it? Okay. Chalo, maybe if you want, I'll just write it fast. I'll not waste more time for sure. I'll make it over here for the next and next year. For example, for which year, let's just cancel it over here, delete everything. Okay, I will just take it up over here. Yeah, I'll copy this, maybe I'll paste it over here. Maybe I'll just make it very small. I'll just crop it so that extra thing now goes away. This is from my examination kit, you need to know. Okay, now I'm taking up this year, 21 and 22. So on which date, guys? Yeah, which date? Come up. 6th April 21 till 5th April 22. Okay, so first I gave 240 to my son. So ma'am, it comes under small gifts, so exempt. Correct. In the current year I'm having 3,000 as my annual exemption is still pending. So what I did, on the day I gave 4,500. So second, on the trust I gave 4,500. So what I can do, I can utilize 3,000 and the remaining 1,500 is to be taxed. Why I cannot go previous year? Because ma'am, I have already consumed it. Yes, I have already utilized it. Now in the next year, which comes up 6/4/22 till 5/4/23, yeah, first was 1,200 to trust. So you'll say, okay ma'am, I'm having an annual exemption of 33,000, out of which initial 1,200 I can adjust it. So my remaining annual exemption remaining is 1,800. Okay. Second, marriage gift of 10,000. Oh wow, 10k. But ma'am, 5,000 is any which way is exempt, so remaining is 5,000. I can utilize ma'am 1,800 from the exemption, so remaining 3,200 needs to be taxed. Clear? Yes. Easy. Done and dusted. Yes. Super. Yeah. Yes, this is how we need to go ahead. Yes. Cool. Okay. Do I have any sort of reliefs applying to the death estate only? So yeah, we'll just go ahead with this. I'm having some sort of reliefs applying to the death estate. That is, the following reliefs can be only applied to the death. That is, if I'm getting only death, means when I'm alive I don't get these type of reliefs. If I am not alive, only then I get this type of relief, otherwise I'll not get these types of reliefs. So what are these types of reliefs which I get only at the time of death? These are three parts, which is known as residential nil rated band. Have you heard this word in your tax rates? Yes. So normally I get NRB, that is nil rated band. But when you are not alive, you get extra benefits. That quick succession relief and double tax relief. So the first one we'll read about inherent taxes on the lifetime transfer. There are some taxes on the lifetime transfers. So first, when an individual makes a gifts to trust, if I'm gifting something to trust, you remember, two things I have to pay. Immediately I have to pay taxes, that is installment, first installment I have to pay, and then in case before 7 years he died, then only I'll pay it. First, when an individual makes a gifts to CLT, immediately he has to pay some taxes. But when it is PET, it's not liable, because I know it only needs to be paid if he dies after 7 years. But PET is not liable for lifetime, and at the time, however, the chargeable amount must be still calculated as PET uses up the available annual exemption. Means even if I'm having PET, I have to take the amount, because I know that will also use some exemptions. Okay. Even if it is never chargeable. Why even if it is never chargeable? When I'm getting some exemption, I take a PET. I know maybe he will not be dying in 7 years, then it is gone. But still you have to utilize it to get a proper thing. Otherwise, so unnecessarily you will charge up the gifts, and you will not pay taxes to government. Yes, this can happen. This can happen. The chargeable amount of each lifetime gifts must be calculated separately, and a timeline should be prepared showing the CLT and PAT for that 7 years accumulation. So students, if you read, this is a pro forma which you have to come up with. Okay, this is a pro forma which is very easy but important. So when I need to calculate the chargeable amount of the taxes, first get what is the chargeable amount of CLT and PET. See what is the value of the gifts. Is it getting reduced? If I'm getting any exemption, please reduce. Exemption from transfer to civil partners, yeah, free, exempt, reduce. Other exemptions like marriage, small, etc., reduce. Annual current exemption of £3,000, reduce. Annual exemption of 3,000 previous years, reduce. And whatever amount you get, it's only to be paid. It's only to be payable. Yes, 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 yes. Now if you read, we have some stage 1 and stage 2. So what is CLT? Chargeable lifetime. Means if I have given to trust. You remember first installment I was saying it off. So what's that? First computation means I will see what is my lifelong taxes. Okay. What is my chargeable amount? Means what is my NRB? What's NRB? So my NRB is nothing other than the nil rated band, which is 325, which is obviously given. Okay, I will use that. Then you have to see whether there is any sort of CLT in the 7 years prior to any gift. If there, please reduce that also. And then pay taxes at the rate of 20%, which I told you. Always the trustee has to pay tax of 20%, 20. Obviously, always. Yes. So a tax liability arises at the time of the transfer, calculating 20%. It is payable by the donor if he agrees to pay. If the transferor pays tax, the gift is referred to be the net gift. Okay, the gift is referred as net gift. So I told you we have to do what? We have to do the gross up. If I'm doing gross up, my liability turns around to be 25%. Liability of whose? Liability of donor, 25%. Liability of donee, that is basically the trust, is 20%. So if you understand this, it needs to be grossed up, which I told you in the first line or only. That if you read it over here, it's going not, it's not getting up down. Yeah. Is it something like 25% is to be charged? Yes. Cool. Okay. If the transferee means the trust agrees, okay, Baba, he'll pay the tax, directly 20% he'll pay. That's all. So please learn these two things if you want. Learn these two things if you want. First priority will always be that the trustee has to pay. So the trust has to pay 20%, but if I pay, the donor pays, it's 25%. It's 25%. And they'll always get a NRB. What's that? First NRB, that is nil rated band over here, is the amount on which the individual will never pay tax. And that is pound 325. So please learn it if you want. If it's always there in your tax rates. So till pound 325, you are not supposed to pay any sort of taxes. It's free. It's free. It's free. So do exemptions, don't pay any taxes. Yeah? Cool? Okay. So this is your initial part which we have learned it upon. Then we'll be having a taper relief. So before we go to taper relief, let's take up a break of 5 minutes and we'll resume it back. So yes students, we'll be just resuming the chapter back, which is one of the favorite topic, yeah, which is known as taper relief. Yeah, so let's get started with what is taper relief. So maybe okay, before I go ahead, I just want to explain you the concept which we normally know. Okay, the inherent taxes which we have is to be paid in both the phases, whether it is PET or maybe the CLT. Okay, so for example, we know that ma'am, I have to pay the taxes only and only additional tax or maybe the normal tax. Okay, I'm just writing it over here. Just try to understand it. Okay, and we know that this table is obviously given in your tax, in your examination. This table will be given. So what it is, see, when it is PET, tax liability, when will it be there? When will you have an IHT? But only after he die, like if he dies before 7 years, you have to pay. For example, if he dies, individual dies before 7 years, or if I'm talking to you about CLT, additional liability, normal to you have to pay, but one about additional if he dies before 7 years, you have to pay, right? So this is a tax liability which you have to pay, an IHT. So the people were not happy. The people asked, the law has asked, okay, hey, what if genuinely he died, so you're going to take the complete tax, can't you give us some reliefs? So on the normal understanding, they just gave us some relief. So what kind of relief they gave us? Try to understand. 20, 40, 60 and 80. To remember the percentage, it's not difficult. 20, 40, 60, 80. So what's that? I'll just draw one line. You will understand it. Okay. So the concept of taper relief has came up to give certain relief and relaxations for the IHT to be paid in the name of PAT, like if he died prior to 7 years, or CLT if he died before 7 years. So what amount of relief can you get it? Guys, just try to understand. Life, I get the taper relief if it's like 7 years, right? So I'll just book it over here. This is 7th year. Prior to 7th year, let's say 6, 5, 4 and 3 and 0. Hey, what's this? What am I writing this? Guys, if a person, you have to go it from this side, left and so, right? Means if a person died in the first year, second year, third year, no. If a person died between 6th year and 7th year, means today he gifted after 6th year, on between 6th and 7th year, after 7th year, if he died, then though it is exempt, yeah, then it is exempt, no doubt. But if he died in between 6th or 7th year, he'll get an 80% relief in tax. Yes. If he died in between 5th to 6th year, he'll get 60% relief. 4th to 5th year, he'll get 40% relief, 20%. But if he died instantly within 3 years, why will you get any relief? Ma'am, 0%. Means, are you getting it what I mean to say? Yeah, just come up over here, just try to understand it. If an individual died after 7th year, you get full 100% relief, that is for sure. But if he died in between 6th to 7th year, then you get 80% relief. Means you were about to die, but you died like some years or maybe some months before. Then you were going to get the relief. So take care, Baba, we'll give you 80% relief. 5th to 6th, 60%, 40%, 30%, 20% each. But if he died between 0 to 3 years, then there is no relief, 0% relief at all, like no relief at all. Okay. So this is a concept which is known as taper relief. So now if you read the taper relief, you'll get it more easy. That means when a gift has been made between 3 years to 7 years before he dies, and the tax has been reduced by this kind of relief. So if he dies between 3 but less than 4 years, 20% relief he'll get. 4 or less than 5, 40, 60 and 80, so on. Okay, cool? Yes. Now there is one more question which is again very interesting one. So yeah, we can do that question also. So that's basically from your activity 2. Yeah, we can just take up the question, which is a combination of all those stuff. So it is going to be very easy. Okay, just try to analyze the question. Mr. Wealthy has made the following gifts during his lifetime. So 1, 2, 3, some gifts he has made during his life. On 20x18, so he gifted some 33, so 333 000 and yeah, 333 000, okay, 333 into a trust. So prior to that, did he gifted anything to the trust? So yeah, we know, ma'am, nothing as such. Ma'am, he hasn't given any sort of gift. Pakka he has not given. Okay. So we know there is an annual exemption of £3,000 in the current year, and if you haven't given anything in the previous year also 3000 you can carry forward, if you remember. Yes. Along with that, ma'am, we have a NRB, nil rated band of 3,25,000, so that you can claim it up. Okay, okay. Hey, this is what I'm just explaining you. We will be doing the questions thoroughly. Okay. Then on 14 November 2020, so after 1819 over 2020, he gave 50,000 pounds towards his daughter. Okay. And on 1st Jan 2021, he gifted some 1 lakh pounds to the trust. Okay. In which here trustee paid the tax, here Mr. Wealth paid. Transferor and transferee paid the tax. You remember, there are some difference in the tax rates. There are certain differences in the tax rate. Somewhere it is 20%, but if a donor pays, it eventually rises up not by 20, it's then at a rate of 25%. You should know the concepts. Yes, that's all. Now what they have asked us in the question, the nil rated band is this much. Acha, you have given it? Cool, chalo, good. I told you this will always be provided in your question. So now, without any further delay, let's just start with the first question. That is, Mr. Wealthy has made up a gift for the lifetime. So what is the gift? So it's on 1st September 2018, he has gifted 33. Okay. So now what I'll do it, I'll just try to formulate the answer. Please try it. Yeah, please try it for the first. Okay. I'm like getting nose itching. Yeah, let's just read. 1st September 2018, he has been gifting something to the trust. So he has made a gift to trust. Of how much he has made a gift for the first transfer of value. So how much transfer he made? Transfer of value. There was a question which was 33. Yeah, he had transferred how much to the trust? 333. Okay. So 333 000. Okay. Will he get the current year's exemption? Yeah, annual exemption he'll get now. For the first year's annual exemption, he'll get 1819, and then he'll get previous year's exemption. So he'll get the annual exemption of 1819 of 3000. Everything in pound, okay? Then he'll get the previous year's exemption, annual exemption of 1718 also, because that exemption has not been yet utilized. So if you take, what is my total? Is it 3,27,000? Yeah, cool, perfect. Will he be getting any sort of NRB? So yeah, you told, okay ma'am, they get NRB, nil rated bands exemption also. Yeah, so NRB over here in the question they have given, it's 325. So if I deduct that, what is the amount on which the tax is to be paid? Yeah, have you paid anything like in the prior year? So yeah, you'll get to know, ma'am, there is a difference of 2000. So yes ma'am, there is a difference of 2000. Yes. So what's this 2000? Yes guys, this 2000 is amount that you have to pay taxes on. This is an amount on which IHT is to be paid, and now it has been paid by trustee. So you know by now it's 20% tax they have to pay. So can you tell me what is the IHT's liability? Yes, it's 400 pounds. I hope this question was pretty easy, which we could manage it the most easiest way. Yes, superb. Now what they have given in the question. So yeah, if you see, this is the first part which I have already completed it. So yeah, this is done and dusted for sure. Now this 14th November 2020, he has gifted 50k to its daughter. Okay, so let me just write it over here. Which is the date? Guys, it's basically on 14th November 2020. Okay, 14th November 2020. He gifted to his daughter gift worth of £50k. So will he get the annual exemption of the year? So see, which is the year, guys, which is the year? Current year is 2021. Previous year is 1920. Agreed? 1920 and 2021. 1920, have you claimed any exemption? No ma'am, it's only 1819 I claimed. 1920 was also pending. Wow, super. So you can claim an exemption of 3000 here, 3000 here. So again, I can claim an exemption of 6k over there. So my amount will be 44,000 pounds only. Clear? Yes. But now this is what? Is it CLT? Have I given this gift to any trust? Then it is potential exempt transfer. I have gifted her. So now I will not pay tax. In case if I die 7 years prior to the life, whatever it is, only then I have to pay tax along with the taper relief. Along with the taper relief, what I normally get it. So okay, now this is not to be taxed. Now this is not to be taxed current year. So what it is? I know I'm very bad at all the stuffs, but yeah, I do take it. So yeah, Baba, it is what? PET. So if individual or the donor dies Before 7 years, only then tax, otherwise no tax, because it's daughter, it's not trust. Last, on 1st Jan, on 1st Jan, on 1st Jan 2021, 1 lakh is to be paid to trust. Okay, 21. Please take the dates. Please take the dates, important. On 1/1/2021. So which is the current year? What is the current year? So if you see, ma'am, it's 2021. Hey, ma'am, I have already taken the current exemption. 1 lakh I have transferred it to trust. So can I take the annual exemption? Ma'am, you have already taken up, no exemption. Ma'am, no exemption, did not allowed only. Then you have to see, okay, whether can I take the exemption of NRB, nil rated band of 325. So you will understand, Kacha, in the previous 7 years, have you taken this exemption anytime? So yes, ma'am, you see, na, here only I have taken NRB's exemption. So again, I cannot take the NRB's exemption. Again, I cannot take the NRB's exemption, so nothing. So now I am going to pay taxes on 1 lakh. But what if I say you, this is to be taxed by whom? Achha, who is going to pay taxes? Is it the donor who is going to pay, or the donee who is going to pay? Is it the donor who is going to pay, or the donee who is going to pay? Wait a minute, like, I don't know how small it will go. Yeah. I just wanted to like flip it there. Just give me a minute, students, please. Are you able to see this clearly? Yeah, okay. So if you see this over here, the trustee is not going to pay. Please see the question. Who is going to pay? Yeah, the wealthy. So person is going to pay. Person means the donor is going to pay the taxes. If the donor pay the taxes to trust, then obviously the donor pays. The donor has to pay how much taxes? They have to pay 25%. So my tax liability turns around to be 25,000 pounds. Clear? Done and dusted this question? Yes. Super easy. This is how I want you guys to like do the questions in your examination also and get the superb marks. Easy peasy. Yes. Now there is something which is very common things which we can just read it for once. That is known as a gift over here. Fall in the value of relief. For example, if you're getting any reliefs means, you know, na, some benefits if I'm getting it, but there can be a situation where whatever relief I thought, I'm getting something lesser than relief. When it is a situation, a gift during a lifetime, CLT and PET fixes a chargeable amount to be given the time of gift. The chargeable amount is calculated at the time of gifts. So the beneficial, so yeah, this is beneficial. There is one example. With this we'll understand it more clear. This is the beneficial where the value of the asset increases in value between the date of gift and the debt. Because we know some of the asset which I gave you, property for example, the value may increase and decrease, isn't it? Maybe the value increases, maybe the value decreases, then what we have to do? So yeah, that is important. Yeah. So you have to, when the donor dies and the asset worth is more, means when the donor dies means, for example, he gifted what? Let's say the house property. Yeah, the donor dies, the asset is more worth and the value has increased. Does not matter. Why? Is it matter? I told you in the day one. On what I will pay? Ma'am, on the day when you have thought of, on the day when you have given the gift, only take that much value. They are just giving you to confuse you. I don't want to get confused. I already know prior that whatever is the value on the day when I gifted, I will take that only. True? Yeah, ma'am, sure. Yes? Super. So in additional consideration or in additional taxes for CLT and normal taxes, it will not be any matter of concern. So simple example they have given. Okay, if he has given some paintings, the day when he gave, it was 2 lakhs, but now it is 4. I don't care, it's frozen. The value is frozen at 2 lakhs only. Simple, understandable, sensible. Yeah. It is therefore sensible tax. So the word is known as sensible tax, means sensible tax planning. It's not like today I'll gift him and 2-3 years ke baad I know I'll die, maybe the value will be more. Why to pay the tax on that day? It's better I'll gift him. No. If you die within a period of 7 years, I'm so sorry, within a period of 7 years you have to pay taxes. You have to pay taxes if you die within a period of 7 years. But if you die after a period of 7 years, it's pretty cool. It's okay, you can die. You can die without tax. So yeah, it's therefore a sensible tax planning to consider giving away the assets during the lifetime that is likely to increase the value. These people do. Why, you know? Today I know this property is going to worth very well, huh? Matlab superb it's going. Chalo na, we'll gift someone so that I don't pay taxes on that. But if I don't gift to someone whose value is increasing, when I will die, and at the time when I will gift him, I will have to pay more taxes. So this is how people do tax planning. But again, this is what you know, it's acceptable also. So that's the reason it is in the law. Otherwise, this will not come up in the law. I hope आपको समझ में आ रहा है. You guys are getting it, yes? Cool. Yes, sir. Or no? Yes. However, an asset can also fall in value after a lifetime gift. Yeah, it can happen. When this happen, it could leave the donee with a problem. Yeah, because he had to pay some more, etc. things. Yeah, maybe fallen down or whatever, he has to pay more taxes. But it's okay. For example, if a person died within 4 years, let's say on the day when he got the gift, the property was valued at, let's say, 1 lakh. But at the date of the 4th year, the value of the property was only 50k, but still he has to pay the tax on 1 lakh. So it's always not that a situation that you get the benefits. Maybe sometimes the donee has to also bear some risks. Yeah, it's that way also. So cool. The amount of the fall in the value of the relief is the difference between what an asset you have originally gifted and the date of the death. That is, gift and the date of the death, we have to consider it. So the following conditions must be satisfied. The asset must be what? It still belongs to the donee at the time of death. Yeah, it should be the donee. Along with that, have been sold by the donee, okay, to whom, or maybe to the parties. But it obviously needs to be something on the arm's length price, and it should not be something which has fallen down. Okay, so it's in the normal course of an action. So it's something in the normal course of an action which you have to do it. Okay. So we just get some relief also. So if you would know, the relief works by reducing the value of the relief. If I'm getting any relief, taper relief and all, your tax and your additional tax will be reduced. So solely you have to calculate the stuff. Okay. That is a transferor's cumulative total, which will remain in the original figure only. And yeah, it will immediately get changed also. So yeah, students, we have a simple question to get the fall in the value relief. Please try to understand. On March 2021, the Jessica transfers a building to her daughter Jackie. Okay, so there is a lady, Jessica, transfers the building to her daughter Jackie, whose value was 2 lakhs. Okay, the value was 2 lakhs. Cool. Now Jessica was supposed to die after 7 years, but eventually she died prior. So Jessica dies on 1st April only. Like you'll say, ma'am, shit, she died like very early. Yeah. So sorry for that. The result in the PAT of 194 after deducting the annual exemption. So she got to know that she is having an annual exemption of how many years? Let's say 2 years. 2 years means 3,000 and 3,000. So maybe she has to pay how much? 194. This is what everyone is clear with, isn't it? Are we clear with this topic? Yeah. So we know, by the way, how it is 194. Okay. At the date of the death, the house was valued. If I valued the house, I got to know what's the property's value. So I valued the house which she gifted was 2 lakhs, but eventually she had the value of 194. She found out the value of the house was valued at only 180. Oh my god, the value of the house has been deteriorated. Now what about? So you will say, okay, ma'am, there is a fall in the value. Fall of how much? Initially it was 2 lakhs, now it is 1.8. So ma'am, there is 0.20's fall. Yes. So that means she got the PAT of 194 and there is a fall. So in short, the chargeable amount to death is 174. Are you getting it? So now this much only is to be taxed. Means whatever is fallen down now, please consider that also. Cool. The amount of the inherent taxes on the death of the Jessica will be this, and the Jackie will have to pay the taxes. Okay, it's still there in the conclusion. Superb. Easy. So now there is something which is calculation for the death estate. Yeah, if the person dies, what about his estate? So everything means what? Whatever the assets and liabilities the person is having, everything is considered as the death estate. Estate of whose? Okay, if I just check the estate, whose estate I'm talking about? All the asset of the person who died. All means all. No matter, even it is like the saving bank interest, anything you have to take it, you have to take that death estate into consideration. So now over here we have some old things, stuff which I'll just explain you. We'll go through it once. On the individual's death, An inheritance charge normally arises on the value of the estate. Estate means its property, everything, every asset. Assets minus some type of liability which he is not supposed to pay. Okay. The value of the taxpayer's final real estate at the death compromises of all the asset belonging to him immediately before his death. Before his death, less with some debts which he is not supposed to pay. So more assets in the death estate are valued at market value, because this is the value at which he has to receive the asset. However, please consider, please, this is very important. If there is an insurance policies, we have to take what amount. However, the insurance policies on the individual's death will be valued at the death estate as a proceeds rather than the market value. Means whatever I got the amount as a proceed, see, whatever normally asset I'm having it, I will consider what? I will consider the value. Which value I will consider? The market value. But if I'm having any assets, sorry, if I'm having any insurance policies, so what will I consider? I would love to consider the value which I'm getting it as a proceed. Yes, super clear. Now repayment, what to be done? So repayment and interest, only mortgages to the property are deducted. Now this is also important. In UK, most of the houses which the taxpayer stays are being in the terms of mortgages. So yes, the repayment and the interest, we know about the mortgages are only deducted from the value of the property, so as to reduce the value of the asset. If it's a home, if it's a house, so if I'm making any sort of payments, so please deduct that. Funds which have been invested is not withdrawn, so we can take that. However, it's possible to withdraw how much? 25% of the pension funds. Okay, so over here, if you can see, there is huge amount of things given which we have to consider and which we don't have to consider. So what are those? Debts incurred before death. Means if I died prior to that, if I was supposed to pay anything, and if they are legally enforceable that I have to pay, so that is also to be taken care of. Which the deceased incurred. So for example, so if unpaid bills, like I was supposed to pay the bills, I haven't paid the bills. If I haven't paid the credit cards bills, yeah, if I, like, before I die, I just went for the shopping, I just shopped a lot, but which I was supposed to pay the bills. Promises which I have made, okay, without consideration by the deceased before death, okay, promises which I have made it. Gambling debts and all. So all these things we have to also consider it. Reasonable funeral expenses deducted. Funeral expenses also they didn't stop it. The spouse exemption is available on death. The total chargeable estate, but only if the chargeable estates are together they will get the gross. So if you see this, it's better to read this. I always emphasize on this prior to any theory because it is easy. Are you able to understand this pro forma? Yeah. If you see this pro forma, oh, just a minute, it is very huge now. So yeah, pro forma. Last stage of computation is the pro forma. So after the chargeable death estate has been calculated, it's necessary to get the pro forma. So what's a chargeable estate? Means that I am having an available NRBR. So what's that? First of all, I am having some nil rated band. Then I am having some residential nil rated band because he is now death. Okay, which is then the question. Yeah, so we get how much nil rated bands in NRBR. Okay, just a minute, I'll just make it smaller. Yeah, because it was very huge now, so maybe that can be an issue which is hitting us. Okay, so stage 3 computation over here, there is there. But okay, prior to that now we will read the NRBR and all. Okay, prior to that I'll just read about the pro forma. So what are my assets and what are my liabilities? Just we need to consider that. Okay, just please try to understand it. What are my assets and what are my liabilities? So what are my assets? First, all my asset. All means all. If I'm still left that my asset, my house property, but if I have paid in loan, if I am still left to pay the interest, please reduce that much. So I reduce that. Then my business, then my shares, stock, government security, insurance policies, proceed what I got, the leasehold property, car, etc, etc. Whatever I have, all are my real estate, my death estate. Okay, then what I will say, if I am left to pay something else, please pay. What payment I have to make it? First, debt by the deceased person. So how much debt I have to incur it? Income tax, or if it's paid, please pay that also. That. Then funeral expenses. Then net value exemption, I'll get it for like charity if I have made, that I'll get the benefits of that. You remember 3-4 things which we learned it. Yes. If you remember political parties, if I'm giving any expenditure, if I'm contributing anything, even that is allowed and everything, get it. Then we have IHC, that is inherent taxes on the death estate. So how much tax will I pay in case if I die? So we have this amount, that is this pro forma. So always remember, there was a concept, 20% tax I will pay when I'm alive, 40% will I pay when I'm dead. So guys, this was something which is given in your questions also. So what will be the amount I have to pay? The gross amount of my real estate, means total amount of estate, total amount of my estate, total amount of my property I will take. And if I'm getting something like I'll die, I'll have over here the residential. If you have a doubt, I'll just open it up. Please guys, have a word on this. Are you getting it? Yes. Is it visible? If I die, I am having a rate of 40% clear. If I die, I'll be having a nil residential and a nil rate also. Getting it? 175 and 325. Yeah? Okay, so what I'll get it over here, nil residential I'll have. If I die, I'll just remove that also and I'll get the amount. If I get the amount on that, so you said, okay ma'am, I have to pay the taxes. Taxes at the rate of 40% if I die. So 40% tax I'll pay. Agreed? Yes? Yeah. So currently, when we are talking about the nil rated bands, residential bands, no, nil rated bands, I have a scope of 3,25,000, 325 I'm having. So till that you don't have to pay any taxes. But please check whether you haven't paid anything in the prior, whether you have utilized this band 7 years prior. If yes, then you will not get it. If you haven't, you will get this much of relief. Okay. The value in excess of the nil rated band is taxed. Lifetime 20, death 40. If I died, we have an additional benefits. See, first of all, who is alive, you're taking up the taxes. You are giving them a benefits of this much. But if somebody died, yeah, please give them extra benefits, extra reliefs. So extra band is basically the extra threshold limit over here. It's known as residential nil rated relief, which will be applicable. So to apply, to get this additional extra thing, also you have to satisfy the condition. Means just imagine how rigorous the things are, right? Means just you're avoiding the tax, you want to pay lesser tax, you have to satisfy so many conditions. You have to satisfy a lot of conditions. So what is the first and the foremost conditions? It is available on the death only, on or after 6th April 2017. After that only you get an extra additional benefit of what amount? Guys, it was £175. Yes guys, you get an extra benefit of £1,75,000. Otherwise you will not get it. So direct descendant refers to children's, only they get it. Means my children's, my step-children's, etc. etc. The property can be anywhere in the world, but must have been the residence of the deceased in some or the other way. And the RNBR is beneficial applied to the priority to main RNB, but it cannot exceed the value of the property. Let's say you are having a taxable payment of, let's say I have to pay a tax of, over here I'm getting 175, right? Let's say my property was, let's say 1,50,000. So you will get up to this only, 1,50,000 only, not 175. That is something which we are very common with. Okay, we know that. Last over here, taper's relief I was getting it. Withdrawal of NRRB. What's that? The RNRB will be withdrawn from real estate if, yeah, please remember, please remember, with the net value exceeding 2 millions. Pound 2 millions. If it's more than that, it will be deducted. The relief will be available of 1 pound for every 2 exceeding. That means, first of all, 20 lakhs you will get it, plus 175 into 2 you will get it. So this much we will get it. So yeah, there is some benefits, you have taken it up. So if you don't understand, please read this question, you will understand these restrictions. It's very easy. Last question over here. So some examples are given. There is a person who died on June 22. He has some estate. So he was having the main residence, cool. He was having the property, okay. He was having his main resident, cool, analyzed. Then he is also having some another personal channels or etc. So his asset was 212. Okay, if you can read it over here, the solution. Yeah, this is a solution. Was his real asset 212? Yeah, ma'am. But then what he did he paid anything? So he never married. Oh, that's cool. But was he into a living relationship? So yeah, that is also to be seen. So he left his estate to his son. Okay, to his son he made it. Okay, fine. He had not made any lifetime transfers. Okay, cool. If he haven't made any lifetime transfer, means definitely there is a chances that he would have never utilized the nil rated band also. So yeah, he'll be getting a benefit of that also. And if he's died, he'll be getting some RNRB. But how much RNRB he'll be getting it? Is it 175? So you have to think, you have to understand how much. So my limit was how much? My limit was 175. But how much I'll get it? So I'll get 50 percentage of my total estate minus 2 million. So 2 pound million. So this is the threshold limit restrictions. So I'll be getting only and only and only to the extent of this much. So if you see now further, yeah, over here they have given, because they have given the restrictions is to 2 millions only. So extra you cannot charge. So 2, and this is my RNRB, this is my normal situation. So this is my leftover amount on which I have to pay IHT at the rate of 40%, and if I pay 40%, this is what I achieve. So this is where we have just completed the chapter, which is basically about inherent tax. And I hope my students, you would have loved this chapter a lot. Like, I know there are a lot of students who have a phobia in like this inherent tax, so they don't learn it. Baba, it's nothing. It's very, 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 very easy. If you liked it, please give me a like. Yeah, please tell me that you liked it. Please tell me that you want to know another chapter also, because I'm trying to make it very easy. Like, if you liked it, please do tell me. Otherwise, I'll like be understanding it on my own. Yeah, that's way. Okay. Next to that, I hope this inherent tax was pretty fine, pretty manageable, easy as well. Yeah. Just take a break of 2 minutes. We'll be resuming back with another concept which is known as VAT, value added tax. Take a break of 2 minutes. So hello students, I welcome you all back with a short and quick revisionary series of VAT. Okay, so today we are going to touch and complete the topic of VAT, which is again the most simplest topic ever. And this is what I have expected, and I am expecting the question to be there from your VAT, and it mostly comes now some theoretical part from the VAT. Okay, so when it is VAT, guys, what's the meaning of value added tax? Is it a tax which I have to directly pay to the government as an income tax what I pay? Is it similar to wealth tax? Is it similar to what I just learned about the inherent tax, or it is something different? Okay. So as to know what is the meaning of value added tax, without any further delay, let's just start with what is VAT. Okay. So normally it's not something which is a directly leviable tax, right? It's not directly leviable. It's something which is known as indirect tax. Indirect means if I am earning income, I have to pay taxes to government. It's a direct tax as income tax. But over here, if I'm purchasing goods, I'm selling goods. If I'm purchasing goods, I am paying them value for goods. Along with that, I'm paying them taxes. If I'm selling goods, I'm collecting the money. Along with that, I'm collecting the taxes money. And now it is my responsibility that whatever sales I have made, I'm going to collect that output tax, adjust the input tax at the time of purchase, and pay to the government. So students, I'm not at all expecting that this is your first time lecture for your VAT. So you know the concepts of VAT for sure, right? So I'm not going into the details of what is value added tax, how we have to calculate it and all. So just simple random understanding, okay, with the way is clear. So VAT is an effectively a consumer expenditure tax, because it's not someone who is going to earn it and pay tax. No, it's a customer who has to bear the tax expenses. If he purchases, he has to pay. Yeah, it's something which is indirectly collected taxes, which is collected from the business at every stage of supply chain. Means if I'm purchasing goods, I have to pay them money, plus I have to pay them taxes. So it is something I can get a credit of it. So it's known as input VAT. But if I'm making sales, I'm getting money. It's inflow. Plus I'm getting tax also. But that is output, because now I have to pay this output tax to government. So can I settle 50 payable, getting 20? Can I just pay 30? Yes, that can be a situation. Okay, just don't worry, we'll just read it for sure. Okay, VAT is effectively a consumer expenditure tax which is collected from business at every stage. So VAT is added at each stage of business, no matter it is an output VAT, yes, for which the supplier gets a credit, or maybe for purchase it's an input tax. So input and output, which can be adjustable, but it is on the head of who's? On the head of consumer only. Consumer only has to bear these taxes. And students, without putting your heads and brains, 20% is the tax of VAT. That's all. Like if you don't understand anything, just get this pic. Okay, I'll just show you once. Yeah, over here, just see it once, and it's like, what it can be more easier than VAT? This is what I feel. Like you are available with so many things available in your examination. Yeah, first of all, the standard rate is 20%, some amount of registration minimum, some amount of deregistration. Clear? Yes. So clear cut, it was 20%. Yes ma'am, 20% was clear. And it's an indirect tax which has been admin by HMRC. My HMRC only, Her Majesty over here, Revenue and Customs. So there's one simple example. We'll just go ahead and we'll wind it up that way. The operator. The first stage, the manufacturer makes a car component and sells to a car dealer. So somebody makes it and they sells it. So at what amount they sell it? So they sell it may manufacture at 80 and they charge 20%, so they'll sell it at 96. So in short, VAT paid over here, it has to pay like 16. If I'm selling it, this much is my output tax. Okay. Now the car dealer holds the inventory and then makes some of the other way sales. So 120 he'll have the cost plus 24 as a VAT. So if you see over here, from the perspective of car dealer, car dealer will purchase at the rate of 16 and will sell at the rate of 24. Means what? He has to pay 24 outputs and get the 16 input. So he can have a net payable of 8. But ultimately, whoever is a customer, he has to bear 24 full. Yes, no other way. Yeah, no other way. Now, what's the general definition? A technical definition of what is something? A taxable person. So we'll understand who is taxable person, who has to pay taxes. A taxable person is someone who is registered and oath to be registered for VAT. So it is registered and has to be. So if you're exceeding some limit, you have to get it registration done. So the VAT is charged on the taxable supply. So we'll be having a different types of supply. Exempt supply, nil rated supply, taxable supply. We'll be understanding what are the types of supply of goods and services made by the taxable person, where the supply can be either both made in UK in the normal course of an action or imported. It's okay. What is taxable supply? I told you there are some supply which are taxable, exempt also, nil rated also. So what's that? A taxable supply is a supply which except an exempt supply or one which is out of the scope of VAT. Means something which on which I have to pay tax is my taxable. So except an exempt supply. So what is exempt supply? On which I don't have to pay tax. On which no tax is to be paid. No input tax, no output tax is paid. Something. Supplies made out of the scope means of VAT are which are not exempt supply, but it will never be treated as the purpose. Means it is not an exempt supply, but it will never be paid that way. So I tell you there are certain supplies which we are divided into. First over here, zero rated supply means, students, people get confused. Zero rated supply is not an exempt supply, means it is not the supply on which you don't have to pay tax. No, you have to pay tax, but it's zero rate. So zero rated supply is not an exempt supply. So please don't get confused. Zero rated supply is a supply on which taxable thing is 0%. So for meanwhile, your tax charge is 0%. Then we have some reduced value. Reduced at what rate? Reduced at the rate of 5%, and these are ignored in exams because they have a standard rate and they only take up 20% only. Yes guys. So this is what we normally take it up. There are certain supplies on which you don't need to pay VAT. Hey, what's that? There are certain services, if I'm getting it or I'm supplying it, value added tax is not a concept for that. For example, the following supplies are exempt. Example, land and building. If I sell land and building, it's exempt. Yeah, there is some other tax you have to pay. Financial services, exempt. Insurance is exempt. Educational institutions, exempt. Health and welfare, exempt. NPOs, exempt. Charitable funds, exempt. The following are the scopes which are outside the scope, means it's not exempt, but it does not come under the concept of VAT only. For example, hey, we know na, on wages, salary, do I pay VAT? Ma'am, it's not thing. Ma'am, it's goods and services. What are you telling about this wages and all? It's out. So wages and dividend, transfer of goods being sold otherwise as a going concern. If the condition is not good to like run the business on, so maybe that could be a situation. Or certain gifts and services. Okay. Intra group of transfer, one group, another group, and export of services, but not within UK. Okay, cool. There are some supplies who have zero rated, means they are not exempt supplies, but they have tax at the rate of 0, which is something which is of day-to-day use. On the day-to-day use, if you are like charging taxes down, people will not be happy. For example, like what? For example, food for human consumption, excluding food provided in the course of catering, means normal for consumption like dal, rice, etc. If I go to hotel industry, they will obviously charge the service taxes and all. Okay, yeah, that is fine. So the human consumption, excluding what? Food for consumption, excluding any food like for beverages, for hot takeaway and something like that. Then sewerage services, yeah, obviously it's very common. Then books, newspapers and all, which are of day-to-day use. New lands and building. Okay, why? You'll get know it later. Transportation of person by any vehicle for 10 or more passengers, means something like public transport. A travel services where travel destination is outside UK. Okay. Then air navigation and all. Cool. Very easy. Now there are certain more supplies, like for example, if I'm having repairs of ships and aircrafts and all, like lifeboat jackets, etc., drugs, medicines, and help for the handicapped people, specified supplies of the goods by the charitable things and all, children's clothing, footwear, etc., the goods exported, very common. Like I don't know why I have taken up this topic, but it's very easy. It's like one time read. It's just like one time read, but people don't read up. So I just came up with the thought of like, let's have an eye on the topic also. Okay. Now, what's the meaning of taxable person? The one who has to make the payments. So a taxable person is an individual, partnership or a company who has to make the taxable supplies and is required to be registered for VAT. Without registration, you cannot pay the tax. Without registration, you cannot pay the VAT also. It is a person who is registered over here. A partnership is treated as a single entity for the purpose of that, and not the business. Thus a person's registration covers the business itself. That means who is required to have a compulsory registration? Just think, just analyze. Who is now required to have a compulsory registration in VAT? Let's say if I want to get registered in VAT, will I be applicable to register in VAT? So if you remember, you have read the tax rates, and there was something like 85,000 pounds. Yeah. So compulsory registration is required if at the end of any month, Jan till December, at the end of any month, taxable supplies in the previous 12 months has been exceeded 85,000 pounds. It means in the previous 12 months, if my taxable supplies is exceeded, that means you are collecting a huge amount of taxes. So it's now your responsibility to get registered in VAT and pay the taxes to the government. Yes. That is at any time taxable supplies or if the previous year it's not there, then you have to see the other conditions. Or at any time, let's say the taxable supplies in the next 30 days alone are expected to exceed 85,000. Okay. That is taxable supplies for this purpose includes all the VAT exercise. Supply means all supply, all VAT supplies. Exclusive of, please. You have to consider all this, all supplies. But excludes supply of capital goods. So we have to calculate all the VAT supplies, zero rated supplies, etc. The potential taxable person must have to notify, they have to inform to HMRC, okay Baba, we want to get registered, so yeah, we'll be doing the registration within 30 days of the end of the month in which I feel, okay Baba, my turnover has been more than 85. Yes, so you guys have to get registered. Yes. Once I am registered, is it always like I'll be registered only? Are the current registration and deregistration limits are given in tax rate, which we know? Yeah, registration was 85 and deregistration was 83. So now what's that? Okay, what's the effective date of registration? From where will I understand that I'm registered? Yeah ma'am, in the previous year, if you remember 12 months, if it was more. So historical test means from the first day of second month after the limit has been completed. And for future, if it is from the date of the ground first existed, that is the start of 30 days period. So over here, however, if the registration was being required under either of the test, it will not be more than what it's been satisfied, that is in 12 months beginning and not exceeding 83,000 pounds. But still, if I'm having anything as a late registration results in penalties for incorrect return. Okay, for incorrect return. Yes. So penalties will be from 30 to 100% if you are deliberately like paying lesser tax and all. Yes. Can a person who is not exceeding this much limit but still wants to get it registered, can it get registered? So yeah, there is voluntary registration also valid. So we have a concept of voluntary registration. So a potential taxable person may voluntarily registered without even getting any satisfaction of the conditions. No, it's okay. So what is it? Is it advantageous to get it registered? So I feel like yes, because it hides the small size of business. Along with that, in future, if you feel like if you are not registered, maybe penalized, so you can avoid penalties. Along with that, I can recover the input, I can pay the output prior. I can do it early. So allows the trader to recover the input, yeah, earlier only. This is particularly advantageous if the business is likely to recover more VAT than it pays. If my input tax is more than my output, please collect it so that guys you get a credit. You get a huge amount of credit. So it is beneficial for them. It also allows the potential taxable suppliers to improve their claims. Yeah. Then you have to see, you have to do some extra administration and okay, fine. who is exempted? Kya acha baba, you don't get registered, it's okay. A person who makes wholly or mainly zero rated supply. Arey baba, if you are not making any supply, or if you're making zero rated supply, means you don't have to pay an output tax. You don't have to pay an output tax. Then what you will do by just getting input? What will you do? Where will you utilize the input? If I don't have to pay anything output, what will I do by taking up so much of input credits? It will be waste. It will be just waste, isn't it? It will be something like reclaim the input VAT by losing. I don't have. After doing registration, if I feel that these conditions are satisfying, I may voluntarily by my own deregister. A taxable supplier may voluntarily deregister if the value of supplies in the next 12 months will be £83,000 or less. Registration will be cancelled on the date from the date when you make the request. A taxable supplier will cease to make the taxable supplies if he gets a compulsory deregister. The HMRC will must be notified within 30 days. Okay, baba. For registration also 30 days, for deregistration also I have to inform my HMRC within a period of 30 days. Just imagine, students, so much of the concepts we did in just 8 minutes. So this is what I want for the revisionary portion. Yes, we'll do it. We'll like nail and dust it. Superb. So over here, if you read it, the VAT return for the final VAT period ending with deregistration must include the output VAT, of all the assets on which the input tax has already been claimed, and then just close it up. Along with that, output VAT over here on the goods held at deregistration and take as a personal use also. But please see, your liability should not exceed more than £1,000. Then it's okay. But if you are doing some business and you think like now your business will not run, then you think that okay, maybe I have to transfer my own business to somebody else, then compulsory deregistration applies when the business is sold or your position is not as well that you can run your own business. Such a transfer will inevitably over here involve the assets falling within the scope. However, they'll try to meet certain conditions also. Yes. What are the conditions? First of all, the business position should be very bad, should be as going concern. But it's a situation that I think like very bad, but I don't want to run it. Maybe somebody else will come up and take up the business. They'll take up the call. And there is no significant breaking in trading, means condition is bad, but still somebody else is coming up and at least managing the business. Then the same type of trade is carried out. It's not a new trade. And the new owner will also have to be registered with VAT. Only then you can like voluntarily cancel. But where a new owner is not registered, what if this happens? For example, where a new owner is not already registered in VAT, then if the old or the new owner deregisters and registers for VAT simultaneously, means the old owner has to deregister it and the new has to register it. Okay, clear? The procedure may be like at times advantageous and okay, the procedure is not compulsory also. Under normal VAT, we know the supply should be what? Okay, under normal, let each limited company is a separate taxable person. If it exceeds more than 85, it has to register. If it loses 83, he has to deregister. For practical reason, a group of companies under common ownership can be having a single registration. That's fine. That's pretty cool. That's acceptable also. A VAT group is what? Where a group means where a group consists of 2 or more companies established and having a place of business in UK are subject to common control. Common control. The control means it should be like more than 50%. We know all this stuff. A VAT group can comprise of both UK resident company and the company is resident away, but having a business place in UK. Then it's fine. Companies can be either taxable or maybe exempt supplier also. If it is so, they have to make an application for the group registration. If I want to have a group registration, what I have to do? I have to ask it first of all to HMRC within a period of 90 days. Once the return has been submitted, they have to check it. Okay, they have to wait for the whole group. Then one company, not necessarily the parent company, has to act as a representative and come up towards other group members and talk towards the admin person, and he has to take up all the groups and remaining thing liable. So that is your registration. Can I get any sort of advantages of doing the group registration, or it's an individual registration better? So if I just take up a group registration under normal VAT, although the VAT on the transactions within the same legal group falls outside the scope, but still there are 2 or 3 different companies. So it's always better to have a registration possible with the company. Okay. So students, now I'm not going ahead with the VAT concepts because I know it's something which is very easy, and over here we have completed a lot of concepts about the VAT which is pretty understandable, right? Pretty understandable. So if you just check up the new things over here, it will be like same things, which is allowed, which is disallowed. So yeah, we'll be going important rules, okay, about the registration, deregistration. We just analyzed it. Let's go towards the important rules. Yeah, what are the basic rules? On what thing I need to have an input VAT, on what thing I need to have an output VAT. Okay, so first of that, the basic rules which must be satisfied for taking up input VAT means the credit is what first. Yeah, so over here if you just check it up, the basic rule which must be identified to be recovered and or to use it in the business are: first, the claimant must be a taxable trader. Even zero rated supplier is fine. The input is evidence to be taxed. The recovery is not blocked. It's not a blocked one blockchain, no. The input is either the purchased or maybe the imported from UK, outside UK, or maybe purchased in UK. Input VAT over here, which is irrecoverable input VAT. That means input VAT means I have purchased something and I want to take the credit of that input VAT. Input VAT on certain expenditure are known as blocked. So please see, this is important. Means if I have made a purchase, but still I just cannot take up the credit of that things. Why? Because it is blocked. Means you cannot utilize the credit of that things. Okay. So what's that first? The value of the goods and services withdrawn from the business for non-business purpose. Non-business purpose means unless output is also accounted for private. So if you are not doing anything for business purpose, like I have purchased something for my personal purposes, the personal purpose credit I cannot utilize towards my setting of my business outputs. No, it's not permissible. So please don't do that. Then if I have purchased new cars, seriously, extra equipment, unless the cars are either being used by the business purpose for hiring, school driving, etc. Acha means if I'm using something for my business purpose, cars and all, and if I'm engaged in that business only, it's acceptable. Otherwise, no. Yes. Or when a new car is leased, means I have taken it on leased, maybe I have leased it, and also 50% is for your lease business and 50% for your own use. So 50% on the lease business only you will get it credit, otherwise you will not get it. And entertaining, that is except other than the stuffs and all. So over here we are having some disallowed input, means on that I cannot allow input VAT, disallowed input on revenue expenditure, capital expenditure. So what is revenue expenditure? For example, some expenditure on which I cannot take any credit, that is which ranks are deductible expense for income tax and corporation tax. So I cannot take. But capital expenditure means, for example, the car, if I have purchased it for my personal use, I cannot take the credit. It's not permissible. It's not permissible. Then what is pre-registration expenditure? Prior to registration, if I made an expenditure, can I take the benefits of that? Where the registration is incurred before registration, where an expenditure is incurred prior, input VAT is recoverable on the first VAT return if the goods are acquired not more than 4 years prior. So long prior, what will you do? 4 years, it's okay. 4 years is acceptable. 4 years prior. Or the business services are 6 months prior. Goods can be 4 years prior. Services can be only 6 months. Otherwise, it will be post-dated and pre-dated, which is again not good. Then we have a very important concept in like we have in India, we have GST. Same way for VAT, we have the most important point, which is known as POS. What is the place of supply? It's not point on supply. Okay, it's not point of supply. It's place of supply. Means over here we have to understand okay, which place, which country, which city, which state I need to understand. Okay, yeah. It's a place so where I can get its supply. So first, there is a rule which says for goods and for services. For goods is the country in which the trader making the supply is registered. Doing the supply is registered. And services means the country where the business customers are receiving the supply. For example, I am giving up a services in UK, so that is my place of supply. I am manufacturing in India, so it's my place of supply. Clear? Yes. Now, what is the meaning of tax value of the supply? Generally, the value of the supply, I'll say towards the value of the sales. So I'll say normally it is a selling price, ma'am. It's the selling price of the goods and services before putting up the VAT charged to the supplier. Okay, the value of the supply is after deducting any trade discounts. Okay, when a cash discount is given, we have to take that, we have to consider that. Okay, what is paid. Then over here, if you know, if I am being allotted, let's say 100, but I haven't taken up VAT. If I have not taken up VAT, if I haven't taken up VAT, so it's like I have to take up a standard thing. So if I haven't taken up VAT, so over here the VAT exclusive will be 100. So I can take up like 20% is the tax rate, right? So without VAT, if it is 100 pound, let's say, so if I'm adding up tax rate of 20%, with VAT my taxable value will be 120 pounds. So it's that only, inclusive and exclusive. You can just read it. And 20% is nothing other than known as standard rated supply, and which should have an inclusive of VAT. Cool? Yes. We have a time of supply, that is known as, I told you, when will I make supply, where it's understood, place, at what time will I make. So the time of supply is a tax point, which is nothing other than the date of supply. This can be either be the basic point and an actual point. So what is the meaning of basic point and what is the meaning of actual tax point? Okay, basic point is legally correct point. What's basic point? Let's say if I'm making a supply of goods, the date when the goods are being dispatched, it's the time on which I make a supply. Getting it? If I'm making a sales on the day, it is a supply. For supplying the services, when the services are complete, after 10 days, after 20 days, after 1 month, that will be my time of supply on which I can book my revenue also. For goods supplied on sales or return means, oh my god, like I have given you, you may return me. So the day when it is finalized, the earlier of when the goods are adopted, or 12 months, whatever is better. And the goods supplied through vending machine, when the machine is completely emptied, it's over, so that's a time of supply. Then what is actual supply? What's actual point? So actual point is the invoice date on which I make the invoice. It's the invoice date, or I got the payment, whichever is earlier. Why is it used? Is it used to understand what's it's used in place of basic point? Yeah. If neither of the event is clear, we will take invoice date, can be used if it falls within 14 days from the basic tax pay. So there are certain normal things which we can just go ahead with. Okay, so it's a gift also. So let's say gifts of goods and services. When a gift of goods and services is made to a non-business or a personal reasons, then what we should do? For example, if I'm giving up goods, let's say for free samples. If I'm giving for free samples, will I take up a VAT? Ma'am, I will not charge. I will not charge. Even the gifts, if I'm giving gift of goods and services, the value does not increase £50 per person. So it's out of the scope only. So it's gifts and all are not taxed. But when the goods and the services are removed from the business for the personal use, we have to consider what? For goods, we have to consider the tax is a replacement and the tax value of the cost of services is the business. So yes students, this is what we have learned, a concept and very great concepts of what we know as a VAT. So I hope you would have just gone through VAT, like it's just a revisionary part. So I have not taken up VAT. I was not planning up to take up a VAT, but I thought like why not? If we have taken up an inherent tax in detail, so yeah, just we'll have an overview of VAT also. So yes students, with this we have completed the concepts of VAT also. So yes, I feel like things are getting very easy. So students, if you have any sort of queries, do let me know. You can always message me in the chat, maybe in the Telegram, or maybe in the link also. We are there on Telegram, we are there on Instagram. You can always message me in maybe like wherever you want. Yeah, so students, if you want any sort of videos which can be again helpful for you, see, I haven't taken this VAT into a details. It's something like which is theory, so what to go in that. So I thought like once we'll just read it. Yeah, Okay students, if you have any doubts, please do message me, please do tell me. And with this we have completed inherent tax and VAT. Then we'll be having some important questions, and then we'll be doing certain mocks also. So I think you guys would have understood it, and yeah, this lecture would have been fruitful for you. So okay, over here, thank you once again, and we'll be meeting in the next session. Thank you and all.